mean, I think the first rates are starting to come through, and we'll have them on your screen. 22,460 is where we are at, which is about 40-50 points lower, I guess, on the index at the word go. So yeah, 75-80 points coming through. And you got the Nifty Bank, which is down about 0.25%, 47,938 right now. The mid-cap index is absolutely flat. Mid-cap index, by the way, from the highs sold off and ended flat yesterday as well. And the small-cap index will come up, which I think should be slightly higher because advanced decline is positive. Okay, small caps are also absolutely flat right now. But these are the indices, 70 points to start with on the downside for the Nifty, but more rates with Sonia.
For that. So since the markets are quiet, I mean, the opening is slightly subdued. Let's go straight to individual stocks, right? We'll take it to HDFC Bank because remember the ADR was up about 5% after the Q4 update came through that lifted sentiment. But also remember there was a reduction in the FII shareholding. So HDFC Bank just holding up in the green a tad bit. Bajaj Finance is the other one. I'm interested to see how that opens up. The FY24 AUM was up 34%. The stock is under a bit of pressure, now down about 1%. Kalyan Jewellers, very strong business update coming through for this quarter. 38% revenue growth for the India operations is what we've seen. Macrotech Developers, as Sonal was telling us, the collections were up 20%. You have the pre-sales, it was up about 40%. So looking pretty good over there. Bandhan Bank, the loans and advances went up 11% quarter on quarter. IndusInd Bank saw the highest deposit growth in the last 3 quarters. Prestige Estates has acquired a land parcel in Bengaluru, so keep an eye out on that. That stock is up 2.5%. And Hero MotoCorp, there's been an IT department tax issuance of almost 605 crores. But this is, for 6 assessment years. It's come through now, although the management has said that this will have no material impact on the company. So it's a sentiment negative that you're seeing on Hero MotoCorp. Puravankara, by the way, should be another stock on your screen. Good Q4 update coming through from Puravankara. In fact, most of these real estate and NBFC companies have reported good numbers this time around. So there's Prestige Estates on the back of the land acquisition. There's Puravankara on the back of the Q4 updates. There's Macrotech Developers. So definitely the entire real estate space is in focus today. Soba is also in focus. It's down about 2% after the Q4 update that came through. But overall for the market, not bad. Still hanging on to 22,500 despite some choppiness from the global markets. Back to you.
Well, thanks a lot for that, Sonia. Well, a couple of stocks that are moving around from the broader markets. Rashi Peripherals, they bagged an order of around 1,500 crores. That stock is up close to around 7%. So big mover this morning. Little known company, but big order win that was flashing for you on the screen a short while back. 6.5% up. SCI Land, I'm not sure what's going on with this stock, but the volumes are very, very high. And the last few days, the stock has been moving up. Today as well, SCI Land is up close to around 10%. Volume movers, the top volume movers, you have JP Power as well as SCPC. Both those 2 stocks are higher. And Gateway Distriparks as well. The volumes out there are unusually high for the first few minutes odd. So we'll have to find out whether or not there is some kind of news flow out there because Gateway Distriparks is up close to around 2% approximately. It has valuation comfort in comparison to Concord. But that one as well moving higher. Pull up a few more names. You had a circuit filter that was flexed. So Irida, you could pull up DB Realty, SCI, Indostar, some of these stocks, they had a circuit filter that was, announced yesterday. And some of them are reacting to that. So explains why some of those stocks have opened up well in the green. But the start is not too bad. From the lows, we've seen a bit of a rebound already. Markets holding at around 22,475 odd. And the Nifty Bank, that's the one that's going to swing it around today. Prashant.
Just a few other names, right, which are opening up. Indraprastha Medical Corp, right? That's the hospital company, the Delhi hospital there. That's opening 13% higher, 13 to 14% higher. I think there was a disclosure from HDFC Bank that they've sold their 3% stake. The disclosure came, I think, yesterday. That they've sold their 3% stake recently. I mean, between the 29th and the 4th of Feb and 4th of April, maybe. I mean, the overhang gone, but there's large volumes as well coming through. It doesn't show up at all with large volumes, but it is today. Reliance Power did very well yesterday. It's up another, these power stocks, right? I mean, most of the gains, of course, have been concentrated in Adani Power, but Reliance Power last 2 days is starting to perform. Oil, of course, is doing well. Oil India is the one which is up 2.5% right now. Prestige, of course, we spoke with a company yesterday on that recently on that agreement. There's Webble Solar, which is up another 3.5%. I'll have to go down the list now to find more stocks. But Cochin Shipyard is shooting up with volumes 4% higher on Cochin Shipyard at this stage. BPHP are, of course, as BPHP, IOC are the biggest losers, biggest volume-led losers at this point in time. Indiabulls Real Estate is another one, right? I mean, it's moved up sharply. The board meeting is today for fundraising, as we've been highlighting. And this Manappuram, which is down about 2% as well. But, I mean, it's done very well on the back of rising gold prices.
Just one mention on Zomato, right? That stock has hit a fresh high today once again at 188 now. So it's a 50% gain that Zomato has seen this year. And if you pull up the chart, you'll realize that ever since they came out with their Q3 guidance, right, where they saw better than expected growth and they upped their revenue growth guidance from 40% to 50%. Ever since they did that, this was a couple of months ago in the month of February, the stock has just been zooming and it's now hit a fresh high. So just wanted to mention that. A 15% gain in a month.
Absolutely. And
we can get a view on that in a short while from now with Samir.
It's one of the top ideas, right? I mean, you want to call it value migration or whatever you want to call it, but it's a duopoly basically, that space. And Zomato, of course, is if you believe recent reports, etc., on market share, it's pulling ahead of Swiggy in many respects, even in the quick commerce space, that is Blinkit. It's pulling ahead. So we can talk about that in a bit. Samir Aurora is now joining us. He's our market master today, founder and fund manager at Helios Capital. Samir, great to have you with us here on the program. Thanks very much. Missed you yesterday at the event. You were missed. So I hope...
Just to see
you're on mute, I think, Samir.
No,
Sorry. Yeah.
Sorry.
Go on.
No, I said I saw a little bit of it on YouTube to see what I have missed. And I did miss the Jugalbandi and all that, which would have been fun to see.
No, I mean, I look forward to having you for the next one, Samir. How are things looking from a market standpoint? Again, that the top in Jan to the low in March was 3.5% on the Nifty. It was a little more for small caps, mid caps, but the gush of money has come in and we've moved right past it, right? So very short-lived, shallow corrections. Another one of those.
That is true.
But that's about it.
If you look at it, that in March, both the FIIs and mutual funds bought so much, I think aggregating to maybe 80,000 crores. And the market didn't go up. I think the market has become very big in the sense that I think we will soon have to stop focusing only on what FIIs are doing and mutual funds are doing. Because this third group of promoters, private equity guys selling doesn't get reflected. For example, a foreign private equity fund selling doesn't get recorded, but an FII buying against it gets recorded. So I think this market will soon go beyond all this. Just like in the US, you don't every day analyze which fund is buying or what they are doing. So, but one way it is good. I'm not saying it is a bad thing. I'm saying for now, I am playing for the budget. I am playing in the sense that I don't want to look at in-between things because the results might be poor in many sectors. Anyway, we think we have less of those sectors. But in a big picture sense, I'm bullish on the budget, or I'm going to decide on that day what to do next in terms of varying my net a little bit, 5%, 10% here or there. Because Mr. Modi himself keeps saying that it'll be a transformational budget. And so let's see what he means by that. And secondly, as the government in the last, the Feb budget said that they will be reducing the fiscal deficit, or that is one of their goals. The only way you can marry these two things, which is have a transformational budget, which normally means that you will invest in new areas. It can't mean that you will cut subsidies or that you will cut government capex. And the fact that you will have a fiscal deficit reduction, if not to the extent indicated, but at least directionally, it can only be done by aggressive selling off some state-owned companies. That is number one way you can do it. And the second way you can do it is to say that the government and the PSUs have a lot of land and that can be monetized, or some other asset, but mostly land, I would think. So if those things happen, it can keep the overall big picture thing positive. Anyway, we are not going to change our net drastically on these things either way, but there's no need to be negative in an environment where, we are okay, the world is okay, why be negative?
Okay. So basically the point, when you say the budget, policy, right? What will be the big thrust?
Policy, but I'm saying because the policy will be reflected first now in the budget, I guess.
But you'll also have manifestos now, right? And they kind of walk the talk in many senses on what they've said so far.
But I don't know. I didn't think about it. Yeah, maybe we have to look at manifestos.
I mean, that'll be out. I think it should be out next week because polling starts 19th.
I know, but I'm saying I have never in the past looked at all these documents. Okay, this time I look at that. So thank you for pointing it out.
No, if
It's
you
like
were to read
saying economic survey, have you read? Only first 2-3 years of my life.
I read a few, but yeah, I get your point. But if you read the tea leaves, Samir, what's going to be the thrust in your opinion? Because,
So as I said,
I remember speaking to many economists, etc., after the budget, the interim budget, and they said, and I asked that question, will the July budget be drastically different? They said, well, no, typically it's not. And the reason why I asked that is because if you look at FY25 numbers, government's allocation on many roads, power, rail, etc., it's actually the pace of allocation to those sectors has come down quite a bit. And that's perfectly fine. Many have said the absorptive capacity is only so much. So now the government can only do so much. The private sector has got to spend. So in your assessment, what's going to be the thrust area? Sorry.
So as I said, that is one. But the second thing is that government going forward has to worry a little bit about taxes because so far the tax collections have been much higher than the economic growth of the country and primarily driven by higher compliance. So beyond a point, you can't keep saying forever that the GDP is growing at say 10-12%, but the collection will be much higher. In the end, it has to be nearly 1-on-1 or maybe 1.2:1 kind of ratio. But in the last few years, it's been higher because we are seeing more and more people who were not taxing, who were evading, who were whatever are coming in. So that has a natural limit of how far it can go. But that's what I said. Mr. Modi himself has said a few times that it will be a transformational budget. I'm saying for me to say that it will be same as usual means that I'll be disappointed that day. I refuse to, on that presumption that no, nothing will happen, get disappointed, right? I don't want to do that because I think it's been said more than once and it will be a laying out of a plan for 5 years. Also, please remember that many of these reforms that are announced, let us say, selling some state-owned companies is considered a reform, which it is. Or you say that monetizing some assets is a good thing. None of that happens within 6-9 months, normally. So it may not happen in the budget period, but it's a big picture macro thing on which you present to the world and to yourself what is the next thing to look for. As I said, these things will not overly change the portfolio. Maybe it'll change 5-10% here or there. My net, instead of 70, I'll make it 60 or something. Or the other way around, saying that, a lot has happened. But I'm saying if you're looking at what is the next with 95% of the time, according to me, you don't need. You just get the ongoing growth of the corporate sector and the earnings. But still, if you say, what is the next? I'm saying budget.
Samir, hi, morning. By the way, you don't need to read any of these documents anymore, right? You have a lot of AI tools for it now. You have ChatGPT and the like. So I think the economic survey, in a minute, you can sort of get done with it.
Well, I have not done that also. Okay, I will learn all these things going forward. And, slowly along the journey, I stopped looking at the railway budget, which was my big highlight. Then I stopped looking at the budget. But before that, I stopped reading the economic surveys and stuff like that.
Okay. Well, no, the only question, Samir, is that I agree that it could be transformational and game-changing and all of that, but how much of it is in the price, right? I mean, from November last year, the Nifty was at what, 18,000? We've climbed a lot in the last 5-6 months. Do you think the best is yet to come?
No. It's not that best is yet to come, but it's not that some big deal has happened. So if you look at last 2-year returns, that is calendar 22 plus calendar 23. In rupee terms, what is the market? And we are not looking at some small cap piddly index. NSE 500, which is the market. It is up cumulatively around 30%. The market was up 4% in 22 and some 24 or 25%, or maybe a little less in 23 calendar year. So over 2 years, the market is up approximately 14-15% annualized. And that is our normal annualized returns for the market. If you look at 5-year returns, or you look at 15-year returns, or you look at 20-year returns, and in that range of 13-15% forever. So even if you look at last calendar year, the earnings growth was, I think, 22%, and the market went up 2% more. And if you look at 22, it was obviously the earning growth was more than 4%. If you look at it in dollars for the last 2 years, I'm talking about 22, 23, leave out this quarter. Then over those calendar years, the market was up only 20% over 2 years, so around 10% per annum. Because in 22, the rupee depreciated 10%. 10% per annum is lower than our nearly any period's returns of our index over more or less any slightly longer period. You take 5 years, 10 years, 15. It's not. The thing is, you only know, and we also know, that our top holdings are not working, which is the banks. We also know that our shorts are not working for other people, which is the IT. Separately,
No,
we know that
Samir,
the
my
consumer is
question
not
was-
working. So what is working? Nothing has worked. So nothing has gone up.
My question was more to do with, does the budget become an incremental, trigger or not? That was my question, Belly. Otherwise, X of the budget, once the budget is out of the way, what is your approach to the market? Because there's one narrative now which says that money is moving out of India and into China. Would you agree with that?
No, I disagree with that. Basically, what is happening is on the margin. For example, just in March, 30,000 crores has been put in by FII just in March, which is like 3 days old news. So nothing is going out. That is story of people who have too much into China and have to desperately try and spin that story. If somebody does a value trade for some time, that is possible. Big picture, I don't think it is happening that more money is going into China than in India, except at the margin by somebody. And even there, last month, that is this March month, India has had one of the highest FII inflows, maybe in many, many years, or I don't know, but broadly a decent enough number. So I was saying, so the Indian market has been compounding in the past in rupee terms at 13-15%, which is more or less in line with the earnings. Today, the valuation is not so attractive that we say it is the best time to invest, but neither is the valuation so bad because it hasn't gone up in the last many years. If you look at the full market, for us to feel this is some bad point to start. So that's why it's a normal market. You will get normal earnings growth plus minus. You will not make any extra money on re-rating, but hopefully you will not lose much money on de-rating of the market. And then these events are required because there are half the audience which doesn't like just the fact that normal earnings are compounding. They want to know when is the quarter ending, when is this happening, what is the FII flow. Actually, all those things in the end don't matter. If the earnings are coming plus minus, you get your returns. But so therefore there is you need a story for longer term also. How will we grow at 7%? Why will we be the fastest growing? We can keep assuming it, but you need that. And not only you need it as a story. The fact that when India or somebody says we are growing at 7%, we take it for granted. But that 7% growth needs all these things to be done. You need a way to raise capital. You need a way for the government to do things so that they can invest. These things don't happen on their own. So for that 6-7% GDP growth, all these things are part of the game. The way we do it is just one thing. For example, Infosys, let's not say Infosys, some company will announce that we will grow our earnings 12% and we say, okay, 12%, it's fair, whatever. And then after some time, the company will say we won an order. And people get excited that the company won an order. Well, the fact that you were growing or you had targeted some 12% growth meant that you are supposed to get X number of orders. It's the same thing with the country. We are assuming a 6-7% growth that needs many things to be done. And so the budget will be one element to say for that kind of crowd which looks at it like that yes, India is doing the right things to be able to grow at those rates, which are world-beating rates. We can't just take it as given. So you need it.
Got it. Hi, Samir. Good morning and good to see you and always good to hear your thoughts. Samir, I was privy to a discussion and people are talking about how much of returns they've made. And one of the participants said, I've made more than 20% in the last 3 months. And he said, I put my money in Helios Flexi Fund. That's done quite well. So kudos to you. I think it was December, January when 22-23%. In fact, he put it in this context. He said, I'm getting annualized returns of 55%. So that's a good start. So that's the way they put it. And then I said, but how come? He said, no, it's already up 23% in 4 months. So I'm annualizing it. Absolutely. That's caution, but good start at least. So kudos. But, no, I'll let my colleagues ask you about HDFC Bank because we've discussed that in the past. I want to ask your view on the paint segment. These paint stocks, they have underperformed actually in the last few years because Birla Group said, we are going to be entering this space. And now Birla Opus has hit the shelves. They're giving more quantity. They're disrupting pricing a little bit. How much of the bad news is in the price? Stocks like Asian Paints, Berger Paints, they were under some pressure. And they were fearing, David taking on Goliath, whoever you want to assume is David and Goliath.
I can't talk much about it because in my offshore fund, I've been short for more than a year, all these paint guys, because it's so obvious that you can't have it like this. That, it's like in the telecom industry, what happened that I used to be a big owner of Bharti in the mutual fund alliance. I was, I think, the largest investor. And then when we came to Helios, we bought Bharti. And then I think it was 2010 or 11 or 12. Something in that period when all these telecom licenses were given and 6, 7, 8 guys landed up, and everybody would say, but in the end, Bharti would be the sole standing or a survivor. And they were. But for many years, they had to fight. So I am not in this game that I am saying, yes, in the end, after 5 years, the big paid guy would have beaten the other paid guys. In between, welcome to real life. And that fight, I am willing to stand aside. But this was all known exactly for more than a year and a half that this will happen because the amount invested or being invested by Birlas is large. And they won't give up on day one, even if in the end you say that the original guys will be winners. These fight, once you put 10, 5, 8,000 crores and you make a big deal about it, you can't say after 3 months, oh, sorry, I made a mistake. So this fight will be done. And for too long, it was one guy deciding the price and others following. So for us, it's not so much whether these stocks fall or not fall now, but it's unlikely that they can outperform. And that is enough for us to be negative on it. That's why you don't see them in those Indian funds. But offshore, now I have to tell you, since you asked me, that I have been for a long time.
So, Samir, earlier you were saying, well, this is not working, that's not working. Did you say humor not working as well towards the end? Or did I miss you? I misheard that.
Why humor will not work? Means?
Humor is working full time, huh? And I want to put out this tweet from you for our viewers. And I really
Which one is this now?
The HDFC Bank one. So it'll come up on your screen. The MSCI HDFC one. So let me just read this out.
HDFC, so I don't know which one.
So I think there were 2 or 3. So it'll come up on your screen, and you said the MSCI process, right? You said if lots of foreign investors have sold lots of HDFC Bank in the recent quarter, then lots of foreign investors will have to buy lots of HDFC Bank in the near future.
So this I must explain because many viewers won't understand what it means.
Yes.
So the logic of this crazy MSCI is that there should be X amount of foreign space or ability to buy, and then they will give the company full weight. Currently, whatever is HDFC Bank combined companies market cap, it's given 50% weight in the index. So the rule is that if you have 25% still available to foreigners to buy, then the weightage will be doubled, which could mean, in theory, something like $4-5 billion of buying required over whatever few months. And so everybody was looking at this quarter's numbers, and that is for March 31st. And the room is 24.95%. I didn't know it that day when I tweeted this, but I said, as long as they've done enough, it'll work out. But unfortunately, the foreigners didn't realize that they were supposed to sell 5 basis points more. And for 5 basis points more, the room for foreign investors would have become 25%. MSCI would have increased the weightage, which would have meant that every other foreigner, and maybe the same foreigner, because the weightage in the index would be so big that the index guys and ETFs and people who follow the index would have all had to buy, which would have been a few billion. Now, unfortunately, it's 24.95, so that doesn't do it. But if they sell now, then next quarter it will be done. Actually, in our morning meeting today, we were saying that maybe HDFC Bank should announce a new, whatever was the thing on maybe April 3rd, maybe in those 3 days it got sold. Because the rule is latest FII ownership, not quarter end.
Okay, Samir, finally, we don't have much time, so I'm going to squeeze in one last question and give me a one-word answer. all these FMCG companies and consumer companies, whether it's Dabur, Marico, HUL, all sitting at all around their 52-week lows, depressed valuations. You think it's a good time to be accumulating these names?
No, we are not accumulating.
Okay. Okay, fair enough.
That is one sentence.
But point made well. Thanks a lot, Samir, for joining in. Appreciate your time here on CNBC TV 18. So that is Helios Capital and, of course, their view on the market. But we had so much market opinion coming through yesterday at our event. Manish Chokani of Enam Holdings said that consumer discretionary goods will be his one big theme going forward. He adds that as the government privatizes effectively to the private sector, privatization beneficiaries will become very large in the future. Listen in to a slice of that conversation.
When you get richer, you don't buy FMCG goods, you buy consumer discretionary. So you spend more money on improving your house, you'll spend a lot more on property, you'll spend on travel, you'll buy a better car, you'll do all your home improvement stuff, you'll go out to eat. So consumer discretionary is one very, very, very big play. Housing, of course,
so you start with that, but do you think it will never trickle down?
No, it will obviously, because each time when you build a home, there are 5 people who are supplying and 10 people who are servicing you. And India has this unique pyramid of that 2% Australians, 18% Filipinos, and then maybe 1 billion people living in Africa, and it will trickle down. And if I then see the math, for example, 20 years ago we were selling 1 million cars, same as China. We have barely crossed 4 million today. China is at 26 million cars. We sell something like 12 or 13 million air conditioners. China is at 220. So that's the scale of change which lies ahead of us in the next 10 years. So that's, of course, one. Second is, as the government privatizes effectively to the private sector. So you've seen effectively Reliance and Bharti have run the telecom infrastructure of India, and we couldn't have run the country in COVID if this wasn't there. Or Adani now runs the ports and the airports of India. Indigo and Tata will run the airlines of India. So all of these privatization beneficiaries will become very, very large. The profit size is very, very large over here. So that's item 2. You and I may not participate because these are not traditionally high return businesses, but you're getting the likes of Blackstone and others to come in. They're taking over even the commercial properties and building REITs. So that's kind of item 2. Item 3, I know we all enjoy doing the Zomatos and all of the world with the internet-enabled businesses can become very, very large in the country. And like you said, in your own field, the rise of Zerodha or even Angel and even yourselves, with what happens with the rise of internet and making life so easy for people, it just explodes the business. And I think we've been beneficiaries of that in our life as well. That clearly is number 3. But the biggest mega theme, and I'm sure Keki and Vaidya will talk about it, is financialization. We are a $4 trillion economy. We save 25%. There's $1 trillion of saving every year. Of that today, only half comes to financial assets. Half is still going to physically buying real estate or gold. So first of all, that has to get financialized. Within that, the share of the banking system has to become much, much larger.
Okay, well, the stock of the moment is Zomato. Just look at that. Big moves coming in there. A fresh high on Zomato now. And almost at 190 rupees, which is a 50% gain that you've seen in 2024 already. And the market cap of Zomato now hitting 1.65 lakh crores. Mitesh Thakkar is joining in. Mitesh, at 190, how is the chart looking? Is there still more headroom?
I think, yes, trading rally hasn't ended. It's had its dips in between. So it continues to make higher highs and higher lows. I think that's a very positive sign. Somebody, if he wants to buy a fresh, I think keep his stop below 177 and look for a target of around 210. And then we'll keep revising as the the stock price keeps making these higher highs. And on my stop calls, I have one buy and one sell. IOC is a sell with a stop at 169 for targets of 156. And Ipca Labs is a buy with a stop at about 1275 for targets of 1350.
All right, Mitesh, thank you very much for that. And we'll have more coming up with Mitesh in terms of trading ideas, etc., as we go along. But we'll take a quick commercial break here. Market's quiet, 40 points lower. On the other side, we get started with our RBI policy coverage with a whole host of guests. We are watching out for the governor's address, of course, at 10. So that's the lineup which is coming up in just a bit from now. Stay with us.
Hello and welcome to our special coverage of the Reserve Bank of India's monetary policy that is set to be announced in just a few minutes from now at 10 o'clock. And we're coming to you live from the Reserve Bank of India headquarters in Mumbai. Let's quickly first get you started with what the street is expecting as per a CNBC TV18 poll. To begin with, this is going to be a status quo policy when it comes to the repo rates as well as the stance which the majority believe will be left unchanged. There's hardly a 10% of the participants that told us that it's possible that RBI may prepare the markets for a shift in stance sometime in the future. So as far as the big, focus areas in this policy itself, the majority of our respondents said they're going to primarily watch out for what the RBI says on growth, where a large majority is expecting an upgrade, and also on inflation, if RBI expresses any concerns about the monsoons or the oil prices going up as well. Apart from this, we asked the respondents when they start to see the first rate cut from RBI, and the majority expects it only by October, with about 40% telling us that perhaps by August is when the Reserve Bank of India could start cutting rates, but no earlier than that. On liquidity as well, the market is going to watch out for any comments from the Reserve Bank of India governor that they will keep the liquidity comfortable in the system. Remember, since the February policy, liquidity conditions have eased, and the RBI has been actively managing liquidity at both ends with multiple interventions in the market. So they expect the governor to signal that the RBI will continue to remain nimble with its operations and keep liquidity comfortable. As far as the inflation forecast is concerned, for FY25, the current projection is 4.5%, and a large majority expects that that will be left unchanged as far as this policy is concerned. But on growth, most of our respondents are expecting an upgrade from 7% for FY25 to anywhere between 7.1 all the way to 7.5%. As far as the tone of the governor is concerned, absolutely even is what we've been hearing from our respondents, so we'll watch out for that. So largely, we're going into this policy expecting no rates changes, no stance change, some perhaps tinkering on the macro parameters, but anything that the governor says as far as the exchange traded currency derivative rules are concerned, or the recent action on many financial entities, all of that is also going to be very closely watched in this policy. So with that, let me invite our guests as well who will be joining us with their expectations from this policy. We have Kaushik Das, who is the Chief Economist at Deutsche Bank with us. Lakshmi Iyer, the CEO, Investment and Strategy at Kotak Alternate Asset Managers. We have Indranil Pan, Chief Economist at Yes Bank, and Parul Mittal Sinha, the Head of Financial Markets India at Standard Chartered Bank. Okay, we have, Lata also joining us all the way from Chicago. It's a late night for her. And Ekta, of course, joining in from the studio to help us take this discussion forward. Lata, let me quickly come to you. What surprise could the RBI really throw? We're going with a business as usual policy into this.
Oh, well, that's how it looks like. And when there is an election in the backdrop, it is unlikely that the Reserve Bank will want any fireworks. So it may keep it, as you said, as even-toned as possible. That's my expectation. The only surprise will be on growth. Will they go all the way to that 7.4%, which they have published in the bulletin? They have a dynamic stochastic general equilibrium model, which forecasts that the year that just ended, the fourth quarter, is likely to be much higher than the residual 5.9%, which the NSO figures indicate. They believe that it will be much higher. So last year's growth can be, close to 8%, but Reserve Bank normally doesn't speak about the year that was. So we won't get anything for FY24, but FY25, will they go all the way to a 7.4? If they do that, that can be a big shot in the arm. And that's precisely what the Reserve Bank may not want. I mean, we don't have too much of goods inflation. They may not want asset inflation in the form of a market rally. So chances are that they may, kind of hold back from going all the way to 7.4% is my guess. Otherwise, there are no surprises. On liquidity, they will have to say something about the money that's coming in or will start coming in because of the bond index inclusion. But, they still have the June policy to speak about that. So they may not say much about liquidity either. That's my best guess. But maybe we want to ask the experts. Kaushik, your first guess. Do you expect that there is a growth upgrade?
Yeah, Lata, I think there will be a growth upgrade because it seems that FY24, the growth could be higher than 7.6, what CSO has indicated. If that goes close to 7.9 or 8, then, RBI may be, willing to increase their growth forecast from 7 to 7.4, as you indicated in the monthly bulletin that came out. So I'm mentally prepared that growth forecast would be raised upward. It will be, in fact, a surprise if they don't. On inflation, I think 4.5% they'll maintain. There could be some tweaks on the quarterly forecast, but overall, I don't see 4.5 changing. I think one possible, surprise that can come, and I'm saying this purely because the last 2 April policies, RBI has surprised whatever the consensus was, that whether there could be a change of stance in this policy. Remember that if you change the stance to neutral, doesn't mean that RBI needs to cut in the next policy. It means you can hike, you can pause, and you can cut, but it gives RBI some bit of flexibility and to guide the market or prepare the market for an eventual easing. And that could be 2-3 policies later. So, April is the policy where we have seen surprises in the last 2 years. So I'll not be entirely surprised if suddenly the stance is changed to neutral.
Okay. Well, let me toss then the same thing to Parul. Parul, dovish, hawkish, neutral, how will this sound?
So we think RBI will do a good job as usual of being very balanced. There is enough to be cautious about. There's enough to cheer about. So they will do a tightrope walk like they usually do, and they do a good job of it. So the core inflation is low. Consumption demand-driven dynamics in the country are very contained. On the other hand, growth is looking robust. So they can talk about both aspects. What we will watch out for is, are they talking about more upside risks to inflation, or are they talking about how inflation is well contained and the inflation forecasts are at 4.5% and giving enough room for positive monetary policy conduct? There are geopolitical risks that have come to the table. If those were not there, so if oil wasn't trading at 90 and above, we would be very positive and we would expect RBI to be able to sound dovish. I think once those risks are behind us, maybe in 2 to 3 months, we do expect RBI to exercise the room they have to sound more dovish.
Okay, all right. Well, as of now, we are just about going flat into policy. We have the Nifty, which is just about lower by around 27 odd points, and the Bank Nifty, which is just about higher by around 55 odd points, so just about consolidating at this point in time. It's a good outcome, despite the weakness that we've seen in Asia as well as the US markets overnight. Indranil, wanted your thoughts just a couple of minutes before we hear the RBI speak for the first time in FY25. What's your sense, given that, Brent crude is now at $90 per barrel and has risen around 10+% since the last policy?
I think Parul has dropped my thought process anyways, in the sense that I think my understanding is that they will possibly sort of tinker with the wording in terms of how they look at inflation. It was only food till now, but now we have all commodity sets going higher. Now, while crude may not have a direct implication in terms of the headline CPI, because the government is controlling the pump head prices and have also reduced it. But it can have an indirect effect in terms of the pass-through. Commodity prices are on the higher side, so that's something to look into in terms of how it has its effect on the headline numbers. Currency is weaker than what we were estimating and understanding to be as we stepped into the new financial year. The last but not the least is edible oil prices are also on the higher side. Now, if you remember last year, the government had controlled edible oil prices or the India impact of the larger edible oil prices globally by cutting customs. Now they do not have that room. And if crude remains on the higher side, we find a close correlation between edible oil prices and crude prices. So that's something also to watch out for in terms of how the overall inflation trajectory pans out. So I think no room to do anything much. In my opinion, no room also to change the stance. Because if they change the stance the way markets are poised at this point in time, they will immediately read it as dovish, and that might not be a very good consequence for most of the other market parameters that we look at. So they will possibly not change the stance, and even in the last MPC policy, they have clearly highlighted that there is no judicious forward-looking guidance that can be put out in the current atmosphere, and I think the thought process will remain the same.
Lakshmi, a quick word from you. We're about to hear from the governor in just a few minutes, so no room or reason really for a change in rates or stance. A quick word on liquidity as well. You know, given that government spend is only expected to again pick up in a couple of months, and this bond inclusion starting June onwards, the kind of inflows that will come in, what do you expect the governor to say on liquidity for the markets?
So, you know, so far they've been managing the liquidity pretty deftly, you know, from a pseudo tightening sort of a mode. They've done some sort of a pseudo easing again and got the the overnight rates very close to where the repo rates are. So I think that oscillation is something which the markets are pretty comfortable with, though we are in a tight liquidity regime as of now. But as you rightly pointed out, over the next quarter probably is when the actual flows will start trickling in, though we've already started seeing glimpses of that. So I think some continuity on that front. Earlier, the markets were expecting some OMOs, I think, but that doesn't seem to be a big concern at this point in time. So I think without any major tweaks, either on the language or on the overall front, I think markets will look out for stability, because at this juncture, no one is really expecting any, I would say, significant nudges from the RBI MPC, and I would say that's true for either asset classes. So I think pretty much status quo on all grounds. And yeah, as Parul rightly alluded to, probably if things were relatively easier from a crude oil perspective or from edible oil perspective, then the leeway to be a slightly more liberal in terms of your words probably could have been there, which may not be the case as of today.
Okay, point taken, Lakshmi. There we have to remember that the last policy got hijacked by the Paytm issue. At the moment, non-monetary policy issues are there, which are kind of warning the market, not unsettling by any means. A couple of NBFCs have been told to withdraw from some of their activities, IIFL and JM Financial. Likewise, we have seen this currency derivatives, the Reserve Bank asking for brokers to check. I mean, they've not exactly told the brokers to check whether the underlying exposure is there, but the fact that they've reiterated that an underlying is needed for currency derivatives is something that the market will watch out for. So these non-monetary policy issues are also going to take away some of the bandwidth. One really wants to know whether the Reserve Bank is worried about the aggressive, the very good growth in the stock market and in growth per se, because that basically tends to mean a wealth effect, higher consumption, and therefore the likelihood of pushing up inflation. So all those dots could be connected. We will have to see whether the Reserve Bank will connect them. Ritu, I think we have just a minute to go. Last thoughts before we get in.
Yes, I mean, like you said, non-policy measures always the focus in the press conference, especially given that, this is a no action policy, so to speak. Also, just a word to our viewers, the monetary policy report, the MPR report, will also be released, in this policy. So we will get some futuristic projections on both inflation and growth and the assumptions that the RBI has made to come to those positions. So that's also another thing that we are going to be watching out for. For the time being, it's almost 10 o'clock, so we will be hearing from the Reserve Bank of India governor shortly. All of our participants are not really expecting any move, but I'll toss it back to my anchor Ekta in the studio for her comments.
Thanks, Ritu, for that. So we're still waiting to hear from the governor. And I think he's there. We can cut across.
The first monetary policy statement of the current financial year, 2024-25. And this is how it goes. As you would be aware, earlier this week, we commemorated the 90th year of the Reserve Bank of India. The journey of this august institution is closely related to the evolution of the Indian economy. Numerous historic events have occurred during these 9 decades. And they consist of the nationalization of the Reserve Bank in 1949, the planning era, bank nationalization, wars, droughts, the fall of the Bretton Woods system, oil shocks, a precarious balance of payment situation and the subsequent market reforms, the Asian and the global financial crisis, the taper tantrum, and finally the COVID-19 pandemic and the geopolitical hostilities of the recent years. During this journey, the Reserve Bank was always at the forefront, combining its developmental and regulatory roles in steering the Indian financial system and the economy towards stability. While doing so, the Reserve Bank has discharged its responsibility with integrity and professionalism. Compared to many other central banks, the Reserve Bank has a much broader range of functions, which is vital for ensuring macro-financial stability of a modern and complex economy like India. There are functional complementarities among the various responsibilities of the Reserve Bank of India. Being a full-service central bank, the Reserve Bank is well positioned to take a holistic view of various critical issues confronting the economy and the financial sector, and it's also well positioned to take appropriate steps in the best interest of the economy. We continuously strive to learn, adapt, and innovate while performing our multiple responsibilities. I would now like to focus on the decisions and deliberations of the Monetary Policy Committee meeting, which met on 3rd, 4th, and today, 5th of April. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Reserve Bank MPC decided by a majority of 5-1 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is the SDF, rate remains at 6.25%, and the marginal standing facility, that is the MSF rate, remains at MSF rate and the bank rate, they remain at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, the growth inflation dynamics have played out favorably. Growth has continued to sustain its momentum, surpassing all projections. Headline inflation has eased to 5.1% during both January and February. And this has come down to 5.1% in these 2 months from the earlier peak of 5.7% in the month of December. Core inflation has also declined steadily over the past 9 months to its lowest level in the series. The fuel component of CPI remained in deflation for 6 consecutive months. Food inflation pressures, however, accentuated in February. Looking ahead, robust growth prospects provide the policy space to remain focused on inflation and ensure its descent to the target of 4%. As the uncertainties in food prices continue to pose challenges, the MPC remains vigilant to the upside risks to inflation that may derail the path of disinflation. Under these circumstances, monetary policy must continue to be actively disinflationary to ensure anchoring of inflation expectations and fuller transmission of the past monetary policy actions. The MPC therefore decided to keep the policy rate unchanged at 6.5% in this meeting and also remain focused on withdrawal of accommodation. The MPC will remain resolute in its commitment to aligning inflation to the target. I would now like to provide an assessment of growth and inflation, and I will begin with the scenario relating to global growth. The global economy has remained resilient with a stable outlook as reflected in various high-frequency indicators. Now, in my statement, whatever I am saying, it is backed up with a lot of data which are there in the footnotes. So those of you who are interested could refer to this statement, which as usual will be uploaded in the RBI website immediately after this statement is over. So a lot of data backing up whatever I am saying is available in the various footnotes of my statement. You may like to refer to it. Let me start again on the global growth part. The global economy has remained resilient with a stable outlook as reflected in various high-frequency indicators. Global trade is expected to grow faster in 2024, although weaker than its historical average. Inflation is moving closer to targets, but the last mile of disinflation is turning out to be challenging. Services inflation in advanced economies remains sticky amidst tight labor markets. Accordingly, central banks are cautious in their communications, thereby tempering market expectations about the timing and magnitude of interest rate cuts later during this year. Equity markets have gained while bond yields and the US dollar have remained volatile. The overall outlook is challenged by continuing geopolitical conflicts, disruptions in trade routes, and high public debt burden. In the last monetary policy statement, if you recall, I had expressed concerns about the high levels of public debt in both advanced and emerging market economies, that is the EMEs. These are dormant risks which could erupt abruptly. Debt to GDP ratio, which rose during the pandemic, remain elevated and are projected to increase further with rising interest burden and cost of borrowing, thus raising debt sustainability concerns. Worsening debt situation in advanced economies, in particular, can generate spillovers for the emerging market economies in the form of swings in capital flows and volatility in financial markets. The emerging market economies with rising levels of public debt, in particular, would be vulnerable to these spillover effects. Credible fiscal consolidation plans, particularly in major advanced economies, focusing on growth-enhancing investment would be necessary to address this challenge, not only for themselves, but also, I think, for the overall global economy. India, however, presents a different picture on account of its fiscal consolidation and faster GDP growth. Turning to domestic growth, the domestic economic activity continues to expand at an accelerated pace, supported by fixed investment and improving global environment. The second advance estimates placed the real GDP growth at 7.6% for 2023-24, the third successive year of 7% or higher growth. From the supply side, industrial activity led by manufacturing continued its momentum. The Purchasing Managers Index, that is PMI for manufacturing, displayed a sustained expansion in both February and March, touching a 16-year high in the month of March. Services sector exhibited broad-based buoyancy, with all sectors within the services sector registering strong growth. The PMI services remained above 60 during February and March, suggesting sustained healthy expansion. With rural demand catching up, consumption is expected to support economic growth in 2024-25. Urban consumption stayed buoyant, as evident from various indicators. Details are given in the footnote. The resilience in cement production, together with strong growth in steel consumption and production and import of capital goods, augur well for the investment cycle to gain further traction. The total flow of resources to the commercial sector from banks and other sources at rupees 31.2 lakh crore. I repeat, at rupees 31.2 lakh crore during 2023-24 is significantly higher than that of the previous year, which was 26.4 lakh crore. External demand improved in February, with exports registering double-digit expansion. Trade deficit, however, widened in February as imports also accelerated. Going forward, the outlook for agriculture and rural activity appears bright, with good Rabi wheat crop and improved prospects of Kharif crops due to expected normal southwest monsoon. Strengthening of rural demand, improving employment conditions and informal sector activity, moderating inflationary pressures, and sustained momentum in manufacturing and services sector should boost private consumption. Let me read this sentence again because there are quite a few points in this. Strengthening of rural demand, improving employment conditions and informal sector activity, moderating inflationary pressures, and sustained momentum in manufacturing and services sector should boost private consumption. As per our survey, consumer confidence 1 year ahead reached a new high. The prospects of investment activity remained bright owing to upturn in private capex cycle becoming steadily broad-based. Persisting let me just rephrase it. The prospects of investment activity remain bright owing to upturn in private capex cycle becoming steadily broad-based, persisting and robust government capital expenditure, healthy balance sheets of banks and corporates, and rising capacity utilization, and finally strengthening business optimism as reflected in our service. I think the sentence is a bit long. It's better that I read it out again for greater clarity. And sorry about that, but I think it provides greater clarity. The prospects of investment activity remain bright owing to upturn in private capex cycle becoming steadily broad-based, persisting and robust government capital expenditure, healthy balance sheets of banks and corporates, rising capacity utilization, especially in the manufacturing sector, and strengthening business optimism as reflected in our surveys. Improving global growth and trade prospects, coupled with our rising integration in global supply chains, are expected to propel external demand for goods and services. The headwinds from protracted geopolitical tensions and increasing disruptions in trade routes, however, pose risks to the overall outlook. Taking all these factors into consideration, the real GDP growth for the current financial year 2024-25, which started on 1st April, The real GDP growth for 24-25 is projected at 7%, with Q1 at 7.1%, Q2 at 6.9%, and both Q3 and Q4 at 7% each. The risks are evenly balanced. Turning to inflation, food price uncertainties continue to weigh on the inflation trajectory going forward. A record Rabi wheat production would help temper price pressures and replenish the buffer stocks. As you would recall, the buffer stocks had slightly dipped, but I think the record Rabi production of wheat is expected to replenish whatever depletion had taken place. Moreover, early indication of a normal monsoon augurs well for the Kharif season. International food prices also remain benign. The tight demand-supply situation in certain categories of pulses and the production outcomes of key vegetables warrant close monitoring, especially in the background of the forecast of above normal temperatures in the coming months. And these above normal temperatures, as per the current forecast, are expected to prevail in April, May and June, and not beyond June. That is the current forecast. Frequent and overlapping adverse climate shocks pose upside risks to the outlook on international and domestic food prices. Cost-push pressures faced by firms are seeing an upward bias after a period of sustained moderation. Deflation in fuel is likely to deepen in the near term, following the cut in LPG prices in the month of March. Notwithstanding the cut in petrol and diesel prices in mid-March, the recent uptick in crude oil prices, especially in the recent few days, they need to be very closely monitored. Continuing geopolitical tensions also pose upside risk to commodity prices and supply chains. Assuming a normal monsoon next year, CPI inflation for, when I say normal monsoon for next year, I mean the current year 24-25. CPI inflation for the current year 24-25 is projected at 4.5%. I repeat, CPI inflation for the current year 24-25 is projected at 4.5%, with Q1 at 4.9%, Q2 at 3.8%, Q3 at 4.6%, and Q4 at 4.5%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? I have explained the growth situation, I have explained the inflation scenario. Synthesizing everything, what does it mean? What implications it has for monetary policy? And that is precisely what I would like to explain now. Inflation has come down significantly but remains above the 4% target. Food inflation continues to exhibit considerable volatility, which is impeding the ongoing disinflation process. High and persistent food inflation could unhinge anchoring of inflation expectations, which is underway. Our ongoing effort is to ensure fuller transmission of policy actions and anchoring of household inflation expectations. The strong growth momentum, together with our GDP projections for 24-25, give us the policy space to unwaveringly focus on price stability. Now, 2 years ago, around this time, when CPI inflation had peaked at 7.8% in April 2022, the elephant in the room was inflation. The elephant has now gone out for a walk and appears to be returning to the forest. We would like the elephant to return to the forest and remain there on a durable basis. In other words, it is essential in the best interest of the economy that CPI inflation continues to moderate and aligns to the target on a durable basis. Till this is achieved, our task remains unfinished. The success in the disinflation process so far should not distract us from vulnerability of the inflation trajectory to the frequent incidence of supply-side shocks. Our effort is to ensure price stability on an enduring basis, paving the way for sustained period of high growth. I would now like to turn to the aspect of liquidity and financial market conditions. In the February monetary policy statement, if you recall, I had mentioned that liquidity conditions were driven by exogenous factors which were likely to correct in the foreseeable future. Liquidity conditions eased during February and March in the wake of increased government spending, Reserve Bank's market operations, and the return leg of US dollar and Indian rupee sale by swap auction, which had been done earlier in 2022. In particular, liquidity situation improved in March with system liquidity turning intermittently surplus in the first half of the month. In these circumstances, the Reserve Bank conducted 14 fine-tuning variable rate repo operations, that is VRRR operations during February and early March to absorb intermittent surplus liquidity. Anticipating the seasonal tightening of liquidity at end March, the Reserve Bank injected liquidity through variable rate, that is VRR operations, both main and fine-tuning operations. Consequently, the average borrowings under the MSF window moderated. Liquidity conditions have, however, again turned surplus from March 30th, necessitating VRR auctions from 2nd of April. So you would have noticed in the last 2-3 days, we have been conducting more than one VRRR auctions. On 2nd April, then again we did it on 3rd April. So last 2-3 days we have been doing it. And today, as you know, there is a variable rate, there is a what you call, as per our cycle, we are doing VRR operation for 14 days, a VRRR operation for 14 days. Now, reflecting these liquidity developments, the weighted average call rate, that is WACR, exhibited a softening bias and has hovered near the repo rate since the last policy meeting. In tandem, rates in the collateralized segment of the call money market have also softened. Financial conditions remained conducive as reflected in reduced term spread in the G-Sec market and stable risk premium in the bond market. In the credit market, monetary transmission continues to be work in progress. Looking ahead, the Reserve Bank will remain nimble and flexible in its liquidity management through both main and fine-tuning operations in both repo and reverse repo. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner that preserves financial stability. The Indian rupee has remained largely range-bound as compared to both its emerging market peers and a few advanced economies during the financial year 2023-24, that is till 31st March last. The Indian rupee was the most stable among major currencies during this period. This is very important. The Indian rupee was the most stable among major currencies during this period. As compared to previous 3 years, the Indian rupee exhibited lowest volatility in 2023-24. The relative stability of the Indian rupee, which I just mentioned, it reflects, I would emphasize, the relative stability of the Indian rupee reflects India's sound macroeconomic fundamentals, financial stability, and improvements in our external position. Turning to financial stability, let me say that latest data as at end December 2023 show that the key indicators of capital and asset quality of scheduled commercial banks continued to be healthy. The financial indicators of non-banking financial companies, that is NBFCs, are also in line with that of the banking system as per the latest data available. Let me emphasize here that banks, NBFCs and other financial entities must continue to give highest priority to quality of governance and adherence to regulatory guidelines. Financial sector players, by and large, operate with public money, be it of depositors in banks and select NBFCs or investors in bonds and other financial instruments. They should always be mindful of this aspect. The Reserve Bank will continue to constructively engage with financial entities in this regard. It needs to be recognized that financial stability is a joint responsibility of all stakeholders. The Reserve Bank has also been engaging with the regulated entities and various stakeholders for simplifying its regulations and reducing compliance burden. As part of this endeavor, the recommendations of the Regulations Review Authority, RRA 2.0, constituted by the Reserve Bank, have been largely implemented. The RRA 2.0 has set a new benchmark for meaningful engagement between the regulator and the regulated entities. Moving further in the same direction, internal review groups within RBI were formed in 2023 to rationalize, simplify, and remove obsolete regulations and streamline the reporting mechanism. In pursuance of the recommendations of the RRA 2.0, that is the Regulations Review Authority, which was constituted by the RBI. So in pursuance of the recommendations of the RRA 2.0 and the internal review groups which we constituted in 2023, more than 1,000 circulars have been withdrawn. A master direction for rationalizing and harmonizing supervisory returns has also been issued. The Reserve Bank will continue to follow a consultative approach and undertake review of regulations in line with the evolving financial landscape. Turning to external sector, during the first 3 quarters of 23-24, India's current account deficit narrowed significantly on account of a moderation in merchandise trade deficit, coupled with robust growth in services exports and strong remittances. India's merchandise and services exports have grown at a healthy pace in the 4th quarter of 23-24. India continues to be the largest recipient of remittances in the world. The cost of receiving remittances is gradually coming down. Overall, the current account deficit for 2024-25 is expected to remain at a level that is both viable and eminently manageable. On the external financing side, India's foreign portfolio investment, that is FPI flows, saw a significant turnaround in 23-24. Net FPI inflows stood at $41.6 billion during 23-24, as against net outflows in the preceding 2 years, which were in the order of 14.1 billion outflow in 21-22 and 4.8 billion outflow in 22-23. This is the second highest level of FPI inflow after 23-24. Net foreign direct investment moderated to $14.2 billion in April-January 23-24 from 25 billion a year ago. External commercial borrowings, that is ECBs, and non-resident deposits recorded higher net inflows compared to the previous year. The amount of ECB agreements also grew markedly in 2023-24 up to February 24. Now, all this data is given, details are given in the footnote. India's foreign exchange reserves reached an all-time high of $645.6 billion as of March 29th this year, March 29, 2024. I repeat, India's foreign exchange reserves reached an all-time high of $645.6 billion as of March 29, 2024. Latest data on various external vulnerability indicators suggest improved resilience of India's external sector. We remain confident of meeting our external financing requirements comfortably. Now, talking about the forex reserves, I recall that in 2021, our forex reserves had also reached 642 plus billion US dollars. Then following the commencement of the war in Ukraine and the outflow of dollar from India as well as from several other countries on safe haven demand, there were concerns that forex reserves of India was going down, and at one point it had gone down. Our forex reserves had gone down to about $524 billion. And at that time, I think several questions were raised about, what was RBI doing, whether RBI was on the right track. If you recall, at that time, we had very clearly assured that the decline in forex reserves was partly due to, the change in valuations of our assets, and also partly due to our intervention in the market to ensure an orderly depreciation of the rupee, which is a part of our policy, ensuring orderly depreciation or orderly appreciation. And we had that time very clearly and firmly stated that we are using our forex reserves in a very judicious manner. It was a strong umbrella which we had built up, and we are using it because it was raining heavily. And we were mindful of what we were doing. We knew what is our purpose and in which direction we are moving. And as you would see, now the reserves have again risen, and they stand at an all-time high of 642.6 billion US dollars, 645.6 billion as of 29th March. So, this is one area on which the Reserve Bank remains committed. Number one, to sort of ensure that, the exchange rate of the rupee is market determined. There are inflows and outflows of dollars happening, but it is our focus, it is our prime focus to build up a strong umbrella, a strong buffer in the form of a substantial quantum of forex reserves, which will help us when the cycle turns or when it rains heavily. So let me move forward. Sorry for that digression, but I thought it was necessary to set the record straight. I shall now announce certain additional measures. The first announcement relates to trading of sovereign green bonds in the International Financial Services Center, IFSC. With a view to facilitating wider non-resident participation in sovereign green bonds, a scheme for investment and trading in these bonds in the IFSC will be notified very shortly. The second announcement relates to the RBI Retail Direct Scheme and introduction of a mobile app to operate the RBI Retail Direct Scheme. The Reserve Bank Retail Direct Scheme was launched in November 2021 for enabling the retail investors to participate in the GSEC market, both in the primary as well as in the secondary market auctions and operations. It is now proposed to launch a mobile app for accessing the Retail Direct portal. This will be of great convenience to retail investors and deepen the GSEC market further. The next announcement relates to review of liquidity coverage ratio, that is LCR framework. Technological developments have enabled bank customers to instantly withdraw or transfer money from their bank accounts. While improving customer convenience, this has also created challenges for banks to deal with potential situations when, due to certain factors, a large number of depositors decide to instantly and simultaneously withdraw their money from the banks. The developments in certain advanced jurisdictions during the last year demonstrated the difficulties it can create for banks. The difficulties it can create for banks to deal with such situations when there is heavy outflow of, heavy outflow or transfer of deposits. And this happens only if that particular bank is in an acute stress. It's not a normal thing which happens, but then the banks will have to remain prepared for all eventualities. A need has therefore arisen to undertake a comprehensive review of the LCR framework for banks. A draft circular will be issued shortly for stakeholder consultation. Our approach is to have a balanced approach, and as I said a little while ago, we follow consultative approach, so therefore the draft circular will enable the stakeholders and the banks to give their views and opinions and suggestions, which will be taken into consideration by the Reserve Bank before arriving at a final decision. The next announcement relates to dealing in rupee interest rate derivative products for small finance banks. At present, small finance banks are permitted to use only interest rate futures for proprietary hedging. It has now been decided to allow small finance banks to use permissible rupee interest derivative products. This will allow further flexibility to small finance banks for hedging their interest rate risk and enhancing their resilience. The next announcement relates to enabling UPI for cash deposit facility. Deposit of cash through cash deposit machines, that is CDMs, is primarily being done through the use of debit cards. Given the experience gained from cardless cash withdrawal using UPI at the ATMs, it is now proposed to facilitate deposit of cash in CDMs, that is in the cash deposit machines, using UPI. This measure will further enhance customer convenience and make currency handling process at banks more efficient. And the next announcement relates to, I have two more announcements and I shall be quick. Next announcement relates to UPI access for prepaid instruments through third-party apps. At present, UPI payments from prepaid payment instruments, that is PPIs, can be made only by using the web or mobile app provided by the PPI issuer itself. It is now proposed to permit the use of third-party UPI apps for making UPI payments from these PPI wallets. That means the PPI wallet holders no longer have to be completely dependent on the PPI issuer, but they can use any other third-party app which is operating under the UPI. This will further enhance customer convenience and boost adoption of digital payments for small value transactions. And the final announcement relates to distribution of central bank digital currency, that is CBDC, the e-rupee, through non-bank payment system operators. The CBDC pilots are currently in operation with increasing number of use cases and participating banks. It is proposed to make CBDC retail accessible to a broader segment of users by enabling non-bank payment system operators to offer CBDC wallets. This will facilitate testing of resiliency of the CBDC platform to handle multi-channel transactions. Let me now conclude, and I would like to state that as we progress towards RBI at 100, the upcoming decade is going to be a transformational journey. The Reserve Bank will continue to focus on preserving financial stability and promoting a system that is robust, resilient, and future-ready. And it will be robust, resilient, and future-ready to support economic growth. Price stability will be a key component of this endeavor. Turning to the present, inflation is on a declining trajectory and GDP growth is buoyant. At this juncture, we should not lower our guard but continue to work towards ensuring that inflation aligns durably and sustainably to the target. Our goal is in sight and we must remain vigilant. We are inspired by the profound words of Mahatma Gandhi, and I quote, "One must persevere and have patience. Success is the inevitable result of such effort." Thank you. Namaskar.
Okay, so no change in rates, no change in stance as expected. I guess the only surprise was the growth forecast for FY25 not being tinkered. With that, let's quickly get you a summary of everything that the governor announced for this policy. The repo rate, of course, being left unchanged at 6.5% with a 5:1 vote. That is, one MPC member dissented on the repo rate action. The stance has been left unchanged as well. On the growth front, you have a 7% projection being maintained for FY25, with the first quarter seen slightly lower now at 7.1% compared to 7.2 earlier. The second quarter at 6.9% growth versus 6.8 earlier. The third and the fourth quarter growth rate seen at 7%. On inflation, RBI said it is going to remain watchful of the developments around crude prices and also on the food inflation, which continues to play spoil sport, but core inflation is something that they take comfort from. For FY25, the CPI projection unchanged at 4.5% for the first quarter. It has been marginally revised lower to 4.9% for the second quarter, again lower at 3.8%, maintained for the third quarter at 4.6%, and slightly lower again for the fourth quarter at 4.5%. Besides this, on liquidity, as the markets expected, the RBI said it is going to remain nimble with its operations, but nothing, to really prepare the markets for what happens when, the bond inflows start coming in from June, or when the government spending picks up. But RBI again saying it is going to remain nimble. Interesting comment on the inflation coming in, that 2 years ago this time the inflation had peaked at 7.8%, and now we're standing at a juncture where the elephant in the room, that was inflation, has taken a walk to the forest, and RBI hopes that it remains there. Apart from this, RBI reiterating that they have enough and more forex buffers, forex reserves at all-time highs to deal with any currency fluctuations. In terms of non-policy measures that were announced, there's a scheme for trading of sovereign green bonds at IFSC, which will be announced shortly. There is an undertaking of a comprehensive review of the LCR liquidity framework for banks, a draft circular for which will be issued shortly. Dealing in rupee interest rate derivative products will be allowed for all small finance banks. And then, of course, there are some, the usual announcements on UPI, some on CBDC as well. So that is the large takeaway. Status quo policy, as expected. The surprise was on growth not being revised upwards. Let me quickly toss it to Lata Venkatesh back there for her editor's take on what the governor said. Lata.
I guess this is the flattest policy I've ever heard. I mean, the only hope we were having of some drama would be if they would up the growth forecast, because it was already there in the bulletin. But, bulletin forecasts get the sanctity only when they enter the MPC statement. Since that's not there, we have to go with 7. So that one small surprise we were expecting, upside surprise, hasn't come. It's absolutely on predictable lines. I think he's trying very hard to say that, he's not going to cut anytime soon. If I remember right, the word inflation figures in the first paragraph or the second paragraph where he talks about inflation probably a dozen times. I lost count. But nevertheless, I took a quick poll from the market. Most people are expecting the first cut in October, and no one has changed their mind. I can tell you how flat the policy is from the way the 10-year moved. The 10-year was at 7.110 before the speech began. It went to 7.11 and remained there. That's how the market has taken it. So entirely on expected lines. Even the inflation figure, although there's some changes in the quarterly mix, the overall inflation forecast for the current year remains the same. I think the only surprise element was that paper that they're going to circulate on LCR, that is the liquidity requirements of bank, how much they have to keep as liquid cash, in high quality government bonds. There is a paper that's going to be circulated. We can see if there'll be any changes, but it looks like it'll only be tinkering. But on that note, let me toss it to the biggest banker who is with us, Mr. C.S. Sethi, of the Managing Director of State Bank of India, is with us. Mr. Sethi, that was the only thing which was a bit of a surprise, the LCR paper to be circulated. Are you expecting any changes? That and any other comments on the policy?
Thank you, Lata. I think, as you mentioned, is broadly on the expected lines. A couple of things, of course, which I would like to borrow from the governor's speech itself, is that the liquidity management being nimble and flexible. I think that we could witness in the last few weeks that the liquidity is not constrained in the system, and whenever liquidity is excess, I think the absorption was done, and when the shortfall is noticed, I think injection was done. So to that extent, I think what governor has assured us in terms of being nimble and flexible is reassuring. On the LCR front, I think the banking currently is 24/7, with the mobile banking adoption and large-scale adoption by the UPI in India also we see. Even RTGS is 24/7 today, which means that the utilization of the banking facilities and withdrawal of money, while it is very unusual case, but it's a fact that the liquidity management in the banks has become more complex. And we also have been talking to the regulator informally that there is a need for looking at the LCR framework. We will await the draft guidelines and see what is coming in there. But I think the concern of the regulator is that probably there could be a little more buffers to be maintained. The large banks like SBI have substantial liquidity buffers over the minimum regulatory LCR requirement of 100%. So while it may be true for the large banks, I think in the system level, there's a need for maintaining the adequate LCR. Probably that is the reason why the RBI is contemplating to relook at the framework. So let's wait for the draft guidelines and see what is coming in there.
Okay. Yeah, I would assume that it can't be anything dramatic. These are largely Basel norms, the liquidity. Mr. Sethi, just one more word. He seemed a little confident on the capex cycle taking over, the private capex cycle. Of course, government capex is doing fine. What's your own sense now that we know that for the moment policy rates are not changing? First of all, do you all expect further transmission? Because he seems to be betting on that. Further hikes are possible in the deposit rate. And secondly, capex cycle.
So I'll first address the capex cycle. We see that I fully agree that the private capex cycle is much more broad-based now. While we had the initial capex commitments coming mainly from the renewables and roads, the capex cycle is private capex cycle particularly is broad-based. We see the improved utilization of our working capital facilities, and which indicates the capacity utilizations have gone up, which again in his speech governor has mentioned. Again I said the capex commitments from the private sector are coming across the sectors, both in terms of the brownfield expansions as well as the new greenfield commitments what they're announcing. I think I fully agree with that, that the private capital cycle seems to be moving in the right direction.
Okay, well, for the markets, it's absolutely sanguine in terms of a reaction. In fact, you'd probably want to say that it's a tad bit positive considering that the mid-caps have moved up. So the mid-cap index is up around 231 odd points post the policy. We have the Bank Nifty, which is marginally higher by around 88 odd points. Upasana, wanted to get your thoughts in. It sounded as though the RBI was much more sanguine about inflation as compared to earlier.
Yes, I think one, I would say that the overall policy is absolutely status quo in line with expectations, no surprises really. And it's a fairly balanced tone. If you just look at what's happening globally, US Treasury yields are higher, crude oil prices have moved up $10 from the last policy to now. Dollar index is higher, rupee is weaker. If you just look at all of this, clearly the risks are increasing. And yet the governor did sound fairly sanguine and balanced about, inflation. At the same time, I think what we need to keep in mind is they seem to be very comfortable from the growth point of view. And like Lata also mentioned, we were expecting there was some probability that a 7.4% as indicated in the bulletin could have been revised up as GDP growth, but that too hasn't been revised. But we clearly know that there is an indication of an upside that they are seeing on growth front after the bulletin data was out. So I think all in all, this is clearly wherein it gives them fair amount of room to wait and watch and let data determine eventually. There are fair amount of risks on the food inflation side. And that is the reason there seems very limited room for RBI to act in the near term. So they will be really looking very cautiously on most of the inflation-linked data and, of course, the global cues. And that's when they can consider change, but that doesn't really happen in H1 at all.
Well, Kaushik, what did you make of the policy, reading between the lines of what the governor said? Of course, overall, it was as expected, but, no revision in that growth forecast that everyone's been talking about, Kaushik.
I think it's a very prudent move not to hike the growth forecast too much, because 7% is quite a good number for FY25. Remember that the more FY24 gets revised up, the base effect becomes more challenging. So to that extent, getting a 7% growth number and not revising it higher, obviously that's a very prudent move, because there are lots of risks on the horizon which could lower growth expectations going forward. It's not just what growth numbers you're getting at this point of time. What is important to also ascertain is 2 quarters or 3 quarters down the line how growth will look like. And there is a bit of uncertainty. So I think 7% is a good number to work with in FY25. The other surprising fact was, despite governor talking a lot about inflation risk, if you see 3 quarters out of the 4 quarters, inflation has been revised downward. And April, June, there could be heat waves and all, but they have revised both the inflation forecast from 5 to 4.9. Even July, September from 4 to 3.8. And more importantly, January, March of 25, from 4.7, they have revised it down to 4.5. So obviously, that's a bit of surprise. If you are hawkish on inflation, then they should not have touched the inflation forecast. Whatever was there was okay, and there was no need for tweaking at this point of time. So that also comes to me as a bit of surprise. But the one thing which obviously is not mentioned, but that will play on the policymakers' mind. Maybe RBI will not talk about it openly, is what happens with the Fed interest rate cycle. So if the US Federal Reserve is kind of delaying their rate cuts, or if they are not going to cut at all in this year, like Neil Kashkari mentioned yesterday, then obviously RBI's hands will be also tied of not providing any monetary easing. Now, RBI will not come out and say that it would kind of depend, the decision would depend directly on the Fed. Probably it doesn't depend directly on the Fed, but to a large extent, what the Fed does and how they kind of guide the market will have repercussion for RBI policy as well. So that is something which we need to look out for when the Fed will start cutting rates, and how much they cut this year versus next year, which will also determine RBI's rate cut actions going forward.
Okay. Got that, Kaushik. Let me get to the bond guys now. Shobit, after listening to the governor, any change in your expectation of when the first rate cut will be?
Tata, I think the policy, as we've all just said, it was exactly on expected lines, no surprises. Given that, even though we would not want to admit, but everybody looks up to what the Fed does. And if the Fed is going to perhaps start the easing cycle with the first rate cut in June, my own guess would be that perhaps RBI could consider an August cut if inflation moves in line as per expectations in the next few prints. However, I think the focus at this stage for the market is policy is behind. It's more about the auction today. We have the first multiple price auction of the 10-year benchmark. It's a large auction, 38,000 crores total, 20,000 crores is the new 10-year benchmark. So I think the market is far more focused today on what the cutoff is likely to be on the benchmark today, because that would be what market would be looking for from RBI from a signaling point of view. Because as you have said, yields have hardly budged because this large auction is pending, and entire market is focused towards what kind of cutoff are we likely to see in the auction today.
Fair point. Well, same question to you actually, Sandeep. Any change in terms of rate cut expectation? The majority I got was August to October, but more leaning towards October.
No, absolutely, Lata. I would echo what Shobit just mentioned. I think a large part of RBI decision making on when the first rate cut would happen would still be linked to when the Fed cuts the first time. And frankly speaking, it's very data dependent, be it India, be it US. And suddenly, it's very difficult to pinpoint whether it's going to be August, whether it's going to be October. or it could even be delayed if data keeps on coming stronger. So we don't really have want to pinpoint when the rate cuts would be. I think largely from how we position ourselves and how we see the markets, we really don't see too many risks of yields rising up, because certainly rate hikes are off the table. And as a positioning part, then we prefer to be long, and we are not trying to probably look at the path dependency, but we do know that the next move is lower for the yields.
Well, we quickly, Upasna, a word from you. The monetary policy report is out, and the FY26 GDP projection here is 7%. That is a flat growth is what RBI is expecting from the 7% again in FY25. And in FY26, the quarterly growth rates are seen in the range of 6.7 to 7.4%. We'll get you the CPI estimate as well in just a bit. But Upasna, what did you make of this number?
I think RBI is clearly not accounting for the global slowdown, which may be delayed for sure, but it will be coming about in probably a couple of quarters. And that is where my fear is that RBI will be missing the target of even 7% for this year and even for next year as well. We are at 6.6% for this year, and the next year we are at 6.5%. So we do see 40 to 50 basis of a downgrade to RBI's estimates, largely because I do not expect the stability in global growth to be maintained through the course of next 2 years. I think we will be seeing a reasonable amount of slowdown. And talking about FY26 inflation, I think they're expecting 4.1% in the MPR, as you mentioned. So 4.1% is something which is achievable. We too are at 4.2% inflation for next year, which also suggests that there will be room created for rate easing in the second half of the year. So if all goes well, growth may have to be revised down, while inflation approaching towards 4% average, 4.1%, is something which further probably validates the case that rate easing is in the offing, just that it may be delayed depending on global and domestic parameters that we have to look at.
Okay, thank you very much, our entire set of guests, Mr. Sethi, Shobit, Sandeep, Upasna, Kaushik, for reading the fine print and telling us how you expect things to pan out from here on. It is, of course, one of the most unexpected lines policy. Even the minor higher expectation of growth has not been acceded to by the governor. He is stuck to the netting of 7%. And that's, I think, a very wise thing to do when you have an election backdrop. It's not that this election is going to throw up much surprises, but considering that it's a lame duck government, the governor should not ruffle feathers. So he's been as even-toned as he could be, and perhaps as he was largely expected to be. This LCR paper is just going to be something that's going to be a discussion paper, and it will not be much tweaking. It is LCR is just the liquidity coverage ratio, the amount of money that any bank has to keep as a percentage of its deposits as easily liquefiable cash. That's the meaning of LCR. It actually aligns with the SLR. So it's about 20%, give or take. The LCR tends to be a little lower than the SLR, but that's unlikely to change things much. So it's really, as expected, a BAU policy, business as usual policy. But we will have to see what comes out of the press conference. There are going to be questions, of course, which Ritu will ask the governor, as will other reporters, on why there have been such a series of actions on the NBFC companies. What has the governor and the RBI thought through in terms of currency derivatives and the underlying required? So the press conference is always going to be the most important and interesting in the Reserve Bank's monetary policy. This is only Act 1, which has ended with flat markets. Market is at 7.1 before the policy began. I mean, the bond yields. It is 7.1 right now. So much for the impact of the policy. Ritu, Ekta, thank you very much. And of course, I will be listening to you at the press conference. That's it on this Act 1 of the monetary policy. At 12, it will be Act 2.
तो मेरे को जैकेट पहनना पड़ेगा.
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay. It's policy day and things have gone as planned. Markets are absolutely quiet, flat in fact. The mid-cap index continues with its rally. The mid-cap index is up nearly 0.5%. And on the gaining side, you've got real estate, PSU banks. I'm not too sure it's because of their interest sensitives or just because they had momentum going for them, which is why they're higher. And on the way down, it's IT on the back foot today.
So, Reema, I think this is probably one of the biggest non-event policies that we've had. It really was a non-event because we didn't get anything new.
Lata's first editorial word was, it's a flat policy, right? That was the word, when we asked her, what's your editorial take?
Yeah, because no change in rates, no change in stance. In terms of commentary also, nothing which really the market's reading too much into as too hawkish or too dovish. So pretty much it is a no change policy indeed. In fact, for me, the one very interesting statement that the RBI governor made was about how RBI is going to be working together with a lot of the regulated entities, where he spoke about the need for the highest standards of corporate governance when it comes to banks and NBFCs. That was telling you probably sort of, addressing a lot of the talk that's been doing the rounds ever since we've seen heightened RBI action on a bunch of players on the NBFC and the fintech side as well. So we'll talk more about the policy as we go forward for the market. Today, the difference is there's one thing which is the same, which is the continuation of trends on banking. And HDFC Bank is up and away once again. Perhaps it's the excitement continuing on, maybe if there is sort of a weightage increase on the MSCI indices, though we know that HDFC Bank is missing the cut by exactly 5 basis points if you go by the math. But I think there's still a lot of chatter about whether, MSCI will kind of make an exception or not. So perhaps it's that. Perhaps it's just buying that's finally started on this one. The update was good and there's continued buying, second day running on HDFC Bank. So that's one important trend. The other important trend for the market is that today mid-caps have come back. So again, you're seeing a screen where the mid-cap index, the small-cap index, these are outperforming the large caps. So mid-caps took a bit of a breather yesterday. But again, the attention and focus is back on the broader market. So
and
that's how it's playing
out. This week what we've seen is that India has outperformed the global markets. If you remember till last week, we were saying that US has had a fantastic, runaway rally. Most of the indices there are up 10, 8, 10, 12, 15%. But India was flat year to date. But this week, you've got the S&P 500 down 2%, the Dow down 3%, while the Nifty is up 0.8%. So India has outperformed the US markets quite considerably this week, and the mid-cap index is up 4% on record right now, at least so far this week. So that's an important element because that, we weren't mapping the US, up moves over the last couple of weeks, but today, this week at least, we've outperformed.
Absolutely. And, before we get to our guests, and we'll have lots of experts lined up for you on the show in just a bit. Before we get to that, just to talk about the movers and shakers in the broader markets, because we're telling you that it is really the mid-cap market where the action is. Look at some of the names, real estate players, Godrej Property, Oberoi Realty. These are names that are popping up on the positive side of the screen. Then you have some newsmakers. You have macro tech developers, of course, came out with the quarterly update. So again, on the real estate side. Voltas is reacting to a good brokerage report that came in. So lots of newsmakers, lots of stocks that are moving up on decent price and volume action as well. Well, let's carry on and start getting you some of that promised perspective on the market. We were speaking to a lot of market veterans yesterday at the CNBC TV 18 India Exchange. Manish Chokhani of Enam Holdings said that consumer discretionary goods will be his one big theme going forward. He's also saying that as the government privatizes effectively to the private sector, privatization beneficiaries could become pretty big in the future. Listen in.
When you get richer, you don't buy FMCG goods, you buy consumer discretionary. So you spend more money on improving your house, you'll spend a lot more on property, you'll spend on travel, you'll buy a better car, you'll do all your home improvement stuff, you'll go out to eat. So consumer discretionary is one very big play. Housing, of course,
so you start with that, but do you think it will never trickle down?
No, it will obviously, because each time when you build a home, there are 5 people who are supplying and 10 people who are servicing you. And India has this unique pyramid of that 2% Australians, 18% Filipinos, and then maybe a billion people living in Africa, and it will trickle down. And if I then see the math, for example, 20 years ago we were selling 1 million cars, same as China. We have barely crossed 4 million today. China is at 26 million cars. We sell something like 12 or 13 million air conditioners. China is at 220. So that's the scale of change which lies ahead of us in the next 10 years. So that's, of course, one. Second is, as the government privatizes effectively to the private sector. So you've seen effectively Reliance and Bharti have run the telecom infrastructure of India, and we couldn't have run the country in COVID if this wasn't there. Or Adani now runs the ports and the airports of India. Indigo and Tata will run the airlines of India. So all of these privatization beneficiaries will become very, very large. The profit size is very, very large over here. So that's item 2. You and I may not participate because these are not traditionally high return businesses, but you're getting the likes of Blackstone and others to come in. They're taking over even the commercial properties and building REITs. So that's kind of item 2. Item 3, I know we all enjoy doing the Zomatos and all of the world with the internet-enabled businesses can become very, very large in the country. And like you said, in your own field, the rise of Zerodha or even Angel and even yourselves, with what happens with the rise of internet and making life so easy for people, it just explodes the business. And I think we've been beneficiaries of that in our life as well. That clearly is number 3. But the biggest mega theme, and I'm sure Keki and Vaidya will talk about it, is financialization. We are a $4 trillion economy. We save 25%. There's $1 trillion of saving every year. Of that today, only half comes to financial assets. Half is still going to physically buying real estate or gold. So first of all, that has to get financialized. Within that, the share of the banking system has to become much, much larger.
Okay, that was Manish Chokhani there with his big themes as you look into the future, the areas that perhaps one can bet on. What an invigorating conversation between the two of them, right? Talking about a lot of different aspects, but I think complete agreement that wherever there's digitization happening, those aspects offer a lot of potential, perhaps.
Oh, indeed. And I think those numbers, right, on where India stands versus China in terms of the number of cars sold or AC, or just the financialization upside, $4 trillion economy, 25% saved, that's $1 trillion, which is going to be financialized at some point. It's going to find its way, back to the banks, which will be, lent out. And that's going to drive that growth. So I think, across the board, I think the common theme was the fact that everyone's a bull, right? It's going to be India's decade, the coming one. But let's also get you some excerpts from our corporate leaders at the India Exchange. Financial services veteran Keki Mistry, IDFC First Bank's Vaidyanathan, and Kedara Capital's Manish Kejriwal caught up with Shireen Bhan to discuss India's growth roadmap. Listen in.
We were talking about connecting the dots in the past as well as forecasting what the future looks like. We've got very optimistic commentary coming in here from both the macros as well as the market perspective. But unleashing the animal spirits, are we on the cusp of a private capex pickup?
Well, first of all, let me say I'm extremely bullish about the Indian economy. I've said this time and again on various shows. I think India's growth that we will see in the coming decade will be a lot faster, a lot bigger, a lot more serious than what you've been seeing over the last 10 years. And I say this on the back of the fact that the penetration level you see of almost any product in India is so low compared to what it exists in the rest of the world. I mean, if you look at financial services, for example, mortgages are about 11% of GDP. In most advanced countries, mortgages are over 50 to 60 to 70% of GDP. And in emerging markets, they're about 20% of GDP. You take total retail credit to GDP, it's around 18%. US is nearly 100%. So we are so underpenetrated that I think the growth that we will see in the coming decade is going to be monumental.
We are talking about the fact that there has already been many changes, structural shifts that have happened that have provided a much more enabling environment for Indian entrepreneurs. But, you know, the point that Manish was also making, and he talked about the privatization aspect, and in many ways also the privatization of monopolies. As you look ahead, you know, what are the changes in addition to what we've already seen the government do to facilitate 1,000 flowers from blooming?
I think the one reform which probably will get some focus, and I think Manish talked about it, which will get focus after the elections, will be labor reforms. I mean, if you are to really grow, you need better labor reforms. To my mind, that is the one area which is still pending.
But really, I mean, is that a constraint? Are labor reforms truly holding back industry from employing more people?
To some extent it is, but I think also I should tell you that from a regulatory standpoint, the focus that is coming on things like ease of doing business, getting things done faster, I think it is phenomenal. I'm chairing one of the SEBI committees on this, and there is so much of focus, so much of attempt being done by the regulators all over the place, not just SEBI, but all the regulators, to try and make the process of doing work simpler and simpler. So I think easier work conditions, some degree of labor reforms, I think these are the things that will come through in the coming.
So the unfinished reform agenda, what would you put down on the wish list? Of course, the aspiration is that there should be less friction in everything related to doing business and, you know, take forward the ease of doing business even further. But if I were to ask you to specifically list out for us, what else you would like the government to do for policy intervention to do to make changes?
See, I think, apart from the very important point said earlier, the small enterprises in India have had a very hard life and a very hard deal. Because the large corporates, you know, because by size, scale, brand, are able to, you know, attract the best talent and get interest at a very low interest, borrow, and so on. The small enterprises are still having a tough time, of course, made better the last few years, but still hard life. So I think that the tax structure of India being uniform across the corporate sector sometimes doesn't sit well with me. I always say that small enterprises,
low rate of tax?
Low rate of tax means like start at zero tax. You make up to 10 lakhs of income, you pay zero tax. I can tell you this next generation of people want to become entrepreneurs if they are in a tax-free economy. And progressive basis, let them all be like us, like for 25%. I mean, I really wish for this, by the way.
Well, let's see if that is something that the government intends to take up in any form or fashion or not. But Manish, you know, to address your issue and many of the concerns that the VCs have had, private equity has had, you know, with the angel tax and so on and so forth, some issues have been resolved. Many continue. Again, this back and forth on capital gains, whether we will see a review, we won't see a review. We don't know what the answers are. Perhaps we will know this budget or the next. But, you know, what's your wish list looking like at this point in time?
Actually, Sharon, it's relatively simple. I think the known issues are evident to everyone in the industry and amongst the regulators. The reality is the RBI, the SEBI, and the Finance Ministry cannot always be looking at the same direction. We hope they would be. They can't. That's the reality of life. I think this last 5 or 6 years, I would say at least the issues are discussed honestly, and the reasons why they can or can't be done or can be done slowly is also relatively clear. Actually, my only wish list, it's not asking for a much lower rate of taxation or no taxes on ABCD. For me, it's consistency of policy. I don't want us stacking left, right, and left, right again. I would love, for example, this might sound like a heresy, but instead of having an annual budget, to have a budget every 3 or 5 years. Why do we need an annual budget? We just give a longer term direction, policies against it, and we move in that direction. Not very dissimilar to where we might be moving towards sort of elections at the state level and the central level. So maybe that's utopian, but that's what I think is.
We are talking about the decadal dividend, Mr. Mistry. So, what will be the preferred engine to your mind? Do you believe that over the next decade we are going to see the consumption boom, or do you believe that it is going to be investment driven?
I would say both, consumption and investment. We've seen a lot of investments coming in the last several years. This year, consumption has been slow. I think consumption will also pick up. So in the next decade, you'll see both investments and consumption growing at the same pace. So that will give that double momentum to the economy.
Same pace? Do you believe that we are likely to see the convergence?
Well, KK has already answered that, but I'll just give you another perspective to that. I think that the really key breakthrough India will achieve over the next 10 years, since we're talking decadal here, we've done financial inclusion at a reasonably good pace in the last 5 years, or maybe 7, 8 years. But I think the big story of the next 10 years is going to be credit being available to the lower end of the economy, because thus far it's already been the large corporates who always got the credit. And I think that's, we talked of animal spirits. We always think of animal spirits, the large corporates, all the, billion-dollar companies. But the animal spirits are sitting there below, and that firing will happen in the next 10 years.
And hopefully that credit gap, the yawning credit gap, at least as far as that constituency.
And will be great for many banks, including for us, of course.
Of course. That's what you're hoping for, Manish.
I don't know if Vaidya is looking at his bank's balance sheet or a future in politics, but it seems to be going in that direction. But it could be both. But I think without investment, you don't get consumption. I actually think the only thing I'll say in a slight subtle shift to Keki is, I do think if you look at this from a 50-year story, the next 10 years should be 75% investment and 25% consumption. If it's a 10-year story, it's half-half. But I really think what we're seeing today, and I mentioned that earlier in terms of the Mumbai being only a small token of the landscape, when you're seeing 35 airports, and you see Mumbai airport and you go to Heathrow and you wonder which is the developed country in the traditional sense of the developing country. So I think our massive years ahead, I do think we need to put more in to reap the fruits in the future.
Okay, that's the interesting conversation that took place yesterday. Get into that break, the promised break. And on the other side, Ajay Srivastava from Dimensions Corporate Finance Services will join us.
Welcome back. You're with us on Trading Hour, and Ajay Srivastava is with us now on the show. Of course, he's CEO of Dimensions Corporate Finance Services. Thank you very much, Ajay. Great to have you on the show as always. So the policy has come and gone. Absolute quiet, non-event sort of a policy this time around. But, the market's in a bit of an interesting space, right? We've got the benchmark indices very close to all-time highs. And it just seems like maybe large banks want to now join in. Your thoughts first, I mean, if there were any takeaways from the policy, and then how do you feel about the market right now?
So I think one is very clear. Here was a man in command. I think this was the first time you've seen an RBI governor using such humorous euphemisms about elephants and elephants going to the forest. And that tells you the state of the mind of the person, that he is in command of the situation. He knows what he's done. He's done a good job. He's got the exchange up. And he is now got a little help from the government on the oil price cut at this point of time. And therefore, he is now saying to the ring, let's keep it. Let's not disturb anything what is there. The status quo continues, and hoping the fact that private capex comes in. And as regard banks are concerned, I think it's a sweet spot now, because with the reduced borrowing by the government of India, which has been come out in the calendar, there is now space for the banks to now start to lend out compared to keeping reserves and buying securities. So all in all, I think it's a commanding performance of an RBI governor in complete comfort and control of the situation on the ground. And that gives you almost, it's like Zen-like comfort. You know what I mean? Zen-like comfort to say, all is well, guys, keep buying shares in the market and I'll look after you.
Okay, and where do you have a Zen-like comfort in terms of the themes? You spoke about banks. What else?
See, very simply, the defense stocks continue to be the darling, because as time goes by, they are seeing greater and greater traction, and we've seen that happening. So I think, no difference in what's changing in the market. Whether it's the hotels, the consumption story at the upper end, the hotels, the airlines, the defense stock, the capex good, I think the same continue. And what not to buy also continue. You don't want to buy a theater company, nobody wants to go there. You are a little worried about the chemical companies. They are facing a global upheaval at this point of time. Agrochem companies not good favor at this point. So I think, it's amazing that you don't need to change your investment philosophy over now almost a year and a half, 2 years. You know what the bad guys are, who's not going to give you return. You know the good guys are giving you fantastic return. Keep away from large consumer companies. They may give you return, but suboptimally. So don't change the themes. That's what I said. He said status quo. Your portfolio should be status quo and add on to it.
Okay, so don't fix what ain't broke, right? I guess that's how they put it. But the only, maybe counter question that we can think to that is whether prices are now already baking in the best possible scenario, or whether, the going is so good that earnings will keep supporting this move. So let's talk about, some of the consumer discretionary plays, Ajay. You mentioned, hotel stocks, travel stocks, etc. Even, things like real estate, discretionary consumption, jewelry stocks. What's your sense there in terms of, the price that you're paying versus the value that you're getting?
Price you pay is not necessarily a function of EPS, P. It's also a function of your state of mind. The day you feel positive about life in general, you feel, you can rule the world. The day you feel negative, even the best shares looks awful at this point of time. I think it's the consumers in India are willing to pay for it, and the credit card outstanding and the loans are showing that they're willing to borrow to pay for such services. On the other hand, the investors are comfortable holding long-term stocks in a long term. Let's say hotel stocks. Now we're talking of a trajectory of an industry which is going to treble in size in next 3 years. We're not talking of 10, 20%. We're talking of the hotel numbers to go up by 2 to 3 times in 3 to 5 year framework. In that perspective, I think you have to be patient with your stocks and look at earnings. Of course, why did I say chemical companies I don't want to buy? Because still the earnings is not good enough. But these are stories which have monopolistic element in them. You can't recreate locations, you can't recreate hotels, you can't recreate retail, you can't recreate a Zomato at the end of the day, you can't recreate these things. And I think those stories have a better traction. So earnings do matter, and they will matter, and you will have correction in the market. But the fact remains that if you look at a plot, a 3-year trajectory, all these industries stand to gain, because competition is not there, or in the ferocity is not there. Unlike spaces like, whether you talk about bulk drugs, etc., where you compete with China and others, here you don't compete with anybody, you compete with Indian companies at the end of the day. So I think, roughly speaking, earnings do matter, but state of mind is, I think, more important. And RBI governor, after seeing him, you should be also Zen-like to say, bad things will happen on a bad day, but ultimately will come out prevail.
You spoke about Zomato, Ajay. So I wanted to get your thoughts in on Zomato. Here, the play has now become more of Blinkit. Because every day Blinkit is adding more categories, new brands, and it's not now competing with a Swiggy. It's practically going to compete with an Amazon and Flipkart. So the addressable market, the TAM for Blinkit is only getting bigger and bigger. In that context, where do you stand on Zomato? For the next 4 years, is it time to look away from the investments, what the bottom line does? Because this is a company where the TAM it's a blue sky scenario.
I don't comment on stocks because but I happen to hold it for disclosure purpose. I've held it for over a year and a half, I think, at this point of time. And therefore, I would say that the same reason applies to it. It has the best thing in the market. It's a first mover advantage. And if it can, and it looks like it has already done all the cash loss business. Amazon is a lousy company in India which makes cash losses. You don't have to be a smart guy to sell 4,000 crore and lose 3,000 crores. You got to be dumb about it. And I think that is where we are going to score. That our Indian companies are doing a lot better because they know the value of money. So when they compete with Amazon, they've got a great advantage is that there is a management sitting on one side which doesn't mind losing almost 60% of sales as the losses in the company. Here is a company which is now built up, done the losses, and is adding on slowly the trajectories. The scale, can you imagine the scale of India, 1 billion people? Just think of it and your mind rocks. So I think you may have corrections, you may have stuff happening, but I can tell you one thing. These Indian companies are going to rule the roost, and you will find the imports going away. And it's a sad story because what happened in banking, and my first job was Citibank. Citibank introduced consumer banking in India, but couldn't handle the competition. Well, guess what they did? They sold the franchise. Now, you got to be thinking really dumb about it, right? But that's the way the American companies work. And I think that's true for whether it is going to be Amazon or it's going to be Flipkart. I think they will see serious competition, and these guys will rule the roost ultimately, because I don't think Amazon understands what retailing is all about. In India, at least, you can't be losing this kind of money on a franchise this strong.
Speaking of banking, Ajay, final question. What weight do banks have in your portfolio? I'm talking about the top tier banks. Because that's where there's a huge debate about whether margins can be as good as they've been. I mean, whether we're pretty much at the peak in terms of asset quality, margins, growth, and whether it goes downhill from here. I mean, where do you stand on that, and what positioning are you giving banks in the portfolio?
See, we brought in banks in our portfolio. After about 2 years, we had zero outstanding to the banks. We brought in the portfolio less than about a month and a half back. It doesn't have a very heavy weightage. It's got about, I think, 10% at this point of time, or maybe less than 10%. But we are increasing our weightage in banks for two simple reasons. I think one is that thanks to the political stability, which is now going to be post the elections, you should see a lot more initiatives coming, and government borrowing should go down, which gives banks a lot of leeway to play around in the market. Number two is now the RBI stance is clear. They will very tightly control NBFCs. NBFCs and fintechs were eating the so-called cheese of the bank. And I think that movement has stopped. Whether it is deliberately or whether it is by accident, the fintech revolution in this country is now slowly grinding to a halt till RBI clears the regulatory. And investors are very wary of putting money in NBFCs, which gives what? Which gives banks the space now to come back and maybe tie up with NBFCs, buy up fintechs, and so on. So our rationale was raw material of money was expensive. They were competing in a market they did not know how to compete with. Thanks to regulatory action of RBI, that format has changed. Banks have got primacy in RBI's views. NBFCs are lower in the category. Fintechs are still lower in the category. So I think, roughly speaking, competitive scenario for the bank has changed dramatically in the last 3 months. And that's what's changed our stance to get into the larger banks. See, smaller banks will do well. Some of them will do well. But the risk inherent in a small bank instability are high. So look at just top 2-3 banks at this point of time, including top 3 nationalized banks, and you're good in the portfolio at this point of time. Even a bank Nifty index is good in the portfolio because you cover most of it. But the key issue is competitive landscape change has made the change in our portfolio allocation.
Ajay, great conversation. Thank you very much for joining. Enjoy your weekend. We will slip into a break on that note. We'll come back, discuss market technicals. Mitesh Thakkar will join in on the other side. Welcome back. You're watching Trading Hour. For the market, it's absolutely flat, but the action continues in the mid-cap universe. The mid-cap index is up 0.5%. The advanced decline ratio is positive. We've got nearly 3 stocks advancing for one on the losing side. Just in the last few minutes, we've seen a little bit of a nick in the markets. The Nifty Bank is holding up with a gain of 150 points as HDFC Bank continues to power through. HDFC Bank is up 1.5%. At a time when Axis Bank, ICICI Bank are all in the red. Axis Bank is down 1%, ICICI Bank is down 0.75 of a percentage point. So outperformance of HDFC Bank versus its other private sector peers continues. Mitesh is now with us. Mitesh, thoughts on the day so far, the mid-cap outperformance, and then your trading picks.
So good morning again. Earlier in the day, I was making this point that today I think it will be the Bank Nifty's day. The structure on the hourly and 2 hourly charts is much stronger for the Bank Nifty compared to the Nifty. So I think that is playing out, and that is, I think, actually also preventing Nifty from going into a big decline. For the timing, focus on financials. We've had earlier in the day buy calls on HDFC Bank as well as a couple of other banking names. So I think that remains the preferred sector. But that apart, currently I have a sell on Page Industries. I think it's a sell with a stop at 34,600 for targets of 33,200. And Petronet is a buy, which I would recommend buying now. It's given a good pullback, so the entry point is good. So that's a buy with a stop below 270 for targets of 290.
Okay, so those are some of the trades that Mitesh has. Mitesh, just stay on. We want to talk to you about Bajaj Finance in particular. Because Bajaj Finance, like a lot of the other lenders, came out with its quarterly update, and if you see the basic numbers, new loans have grown at 4%. So, and then quarter on quarter, of course, is a decline in new loans. So, not seeing too much of a huge uptick here, which is usually the case with Bajaj Finance. We've got Abhishek joining in. Abhishek, what do you make of it? I mean, 4% year-on-year growth. That's not the kind of number that one is used to seeing from Bajaj Finance.
No, but why do you want an uptick when your new loans have actually declined more than 20% on a sequential basis? Although RBI diktat is there with respect to, their e-com as well as Insta EMI cards, and that is about 8 lakh loans. This would, even if you exclude this, the new loans are down more than 13% on a sequential basis. So there is a pain in the new loans. They are down one of the highest that you are seeing in last 15 quarters. That's down about 20% plus on a sequential basis. So this is the RBI diktat has also impacted their cross-sell ability. So the cross-sell rate is down to 5.54%, which is perhaps one of the lowest in last 11 quarters. Now by cross-sell rate, I mean the same customer can be given another loan after the previous loan. So that cross-sell rate has actually declined. Customer base is up 21% YOY and about 4% sequentially. Deposit momentum has slowed down. Deposit used to grow anywhere between 5% to 10% on a sequential basis, but this time around it's coming at 3.6% on a quarter-on-quarter basis. Average ticket size that continues to remain steady, growing at more than 10% YOY and more than 2% sequentially. The AM growth is at 33.5% YOY and about 6.25% sequentially. Sequentially or quarter-on-quarter, this is one of the weakest growth that you are seeing in last 4 to 5 quarters. Back to you.
Absolutely. Just stay on, Abhishek, because we want to talk to you about some of the other quarterly updates as well. But let's just do a chart check on this stock. Mitesh, Bajaj Finance hasn't done anything. I mean, absolutely flat in 2024. It's an underperformer looking at the excitement in the rest of the market. What are the important levels? Would you look at any trade here at all?
Sulvi, I think the stock has, had actually corrected in the first quarter of the year, went down to as low as 6,200, approximately those levels, and from there it's bounced back. So I think it's, it's still consolidating. If you look at the longer term charts, we've not seen the stock capture 8,000 decisively, though I think it's hit that level a couple of times in the last few years. And on the downside, I think, we had earlier multiple supports around 5,500. That range is now shifted up to about 62, 6,300. So I think it's still range bound, but in the short term, I think, on a pullback, last couple of days, we have seen a pullback here. So around 7,000, a short-term trade with a 6,900 as a stop can be taken. And I think it can yet do 7,600, but I'm not looking at a long-term breakout happening over here.
Mitesh, thank you very much for that. A lot of other, banking updates have also come out from IndusInd Bank, Aavas Financiers. Abhishek, what are the key trends that you've picked up?
Well, Rima, if you take a look at, IndusInd Bank, it's a mixed bag reported in their business update. Now, deposit growth is lower when you compare to other peers, but for what it's worth in itself, that is for the individual bank, the deposit growth momentum has picked up a bit in this quarter. Deposits are up 14.4% YOY, which is one of the highest in last 3 quarters. Sequential growth is about 4.3% quarter on quarter, which is the highest in last 11 quarters. However, CASA ratio on the flip side is one of the lowest that you are seeing in last 6-7 years. That is about 27 quarter low, coming in at 37.9% when compared to 38.5% in the previous quarter. Retail deposits are up 18.5% YOY and 2.5% quarter on quarter, which has meant that the retail deposit share in the overall deposits have declined both YOY as well as quarter on quarter. It means that cost of funds might have risen for them because retail deposits are generally cheaper in nature when you compare to other deposits. Advances growth, YOY, it's an 18.3% YOY growth, one of the lowest that you are seeing in last 6 quarters, and 4.8% growth on a sequential basis is perhaps one of the best in last 4 quarters. The CD ratio, credit to deposit ratio, has improved marginally on a sequential basis and is one of the highest in last 15 quarters, coming in at 89.1% when compared to 88.7% that they had in the previous quarter. Aavas Finance's strong disbursals have actually led to healthy AUM growth this time around for the entity. Disbursals are up 38.7% quarter on quarter. So AUM growth has been at 22.1% YOY and about 7.6% quarter on quarter. Disbursal to AUM ratio, that's remains steady at 64.5% when compared to 66.7% in the previous quarter. And their asset quality has also shown a marginal improvement on a sequential basis. Back to you.
Okay, all right, got that, Abhishek. Yeah, those are solid-looking numbers from Aavas Financiers. Thanks for rounding up all of that action from the BFSI space. We'll quickly take a break on that note, come back on the other side, and we will have a guest on the fundamentals with us, Sunny Agarwal from SBI Securities will join in. Welcome back. Here with us on Trading Hour. Sunny Agarwal, Head of Fundamental Research at SBI Securities, is with us. Sunny, great to have you on the show. So I want to start first with a question on banks. We were just discussing a lot of the updates that have come in. And yesterday, the small finance banks, a lot of those stocks were excited because of good updates. Today, Aavas is, reacting to those numbers. So just tell us which ones stand out for you, your thoughts on what we've seen in Q4.
Yeah, good morning, Surbhi, and thanks for having me on the show. So I think among the small finance banks, Suryodaya Small Finance Bank is the one bank where I see we have seen an outlier number. So advances growing by 41% year over year and sequentially up by 14%. Deposit up by 50% year over year and sequentially up by 20%. So CASA deposit up by 77% year over year and 31% Q on Q. So I think a standout number by Suryoday Small Finance Bank. Although it's a small bank, in terms of market cap, it's a very small, but I think the outlier number coming from the Suryoday Small Finance Bank. And another one on the, if you go for a mid-sized, small-sized bank, I think Catholic Syrian Bank, CSB Bank is a bank which has reported a decent set of number. So advances up by 18% year over year, 7% up sequentially, and deposit up by 21% year over year and 9% sequentially. So Catholic Syrian Bank and Suryoday Small Finance Bank.
Sunny, your view is that market returns from here on, the expectations need to be tempered down. It's not going to be the kind of returns we've gotten used to, and therefore it's a stock selection approach. In large caps, now many of your top picks, whether it's L&T, ITC, Maruti, these all stocks have done very well in the last 1 year. So amongst your large, top picks, where is it that you see value right now? If one has to buy 3 stocks in the, amongst your large cap, which ones would you recommend?
So yeah, Rima, so I would like to go ahead with Mahindra and Mahindra first. I think their SUV portfolio, that is passenger vehicle portfolio, continue to do well, a robust order book. At the same time, they are increasing their manufacturing capacity. So I think that will add a margin kicker in FY25. At the same time, a lot of their subsidiaries are turning around, and on a SOTP basis, I feel the fair value of Mahindra and Mahindra is close to 2,300, 2,400 rupees. So that will be one of my top pick for FY25. Moving on to the next pick, I would like to go ahead with Canara Bank and Union Bank. Both the banks are likely to grow by 10 to 12% as far as advances is concerned. Trading at a reasonable valuation, close to 1.2 time price to book, 1% ROA. I think there is still a lot of catch up to happen as far as valuations are concerned. So among the PSU bank, I would like to go ahead with Canara Bank and Union Bank. And one consumer company I would like to bet on is Tata Consumer. Although we have seen a weaker set of commentary coming from Dabur as far as provisional numbers are concerned. But I feel Tata Consumer is a play on both organic as well as inorganic growth. So Tata Consumer is one of the pick among the large cap.
All right, I got that. By the way, I was just looking at Zomato's move today, and it's not just today. Zomato, we know, has been moving for a while. Pull up the chart. Today it's up to 2.5%. And what a spectacular journey in 2024. The stock has put on about 54% in 24, and it is this year that it finally surpassed the IPO price as well. The listing was closer to 150. There were concerns, the whole issue about profitability, but it sort of navigated that extremely well. And it's really the poster child of the new age internet companies pack, so to speak. Massive move there in the last 12 months. Sunny, your thoughts on Zomato? Do you like the stock? Is it under coverage? And how do valuations look?
Yeah, so I think, again, we continue to remain bullish on Zomato. The reason being that both their businesses, whether it is a grocery business and food delivery business, continue to do well, especially the Blinkit one, where we are seeing a rapid growth. At the same time, recently company is moving on to monetize that piece of business by charging platform fee or delivery fee. So I think that will straight away add to the bottom line. And I think the runway is pretty long as far as all these internet-based companies are concerned. Still, the users are very less. So I think at the same time, there is an opportunity to penetrate into the new cities. So we continue to remain bullish on Zomato. Valuation may appear to be expensive because the company has just turned profitable a quarter or two back. So one need to have a slightly longer horizon and write the entire story for next 5 to 10 years.
RR Kabel is also one of your, stock recommendations. Again, this is a stock where we have seen a fair amount of upside. What from here?
Yeah, so what I feel is that RR Kabel is a play on basically electrification story of India. So we are seeing that day by day with the manufacturing contribution increasing in the economy. The electrification is something which is electrification infrastructure is something which is likely to expand or at a rapid pace over the period of next 3 to 5 years. And I feel the RR Cable is a proxy play to that electrification story.
No, actually, it's also RR Kabel versus Polycab. and which one does one pick? Because both of them, in a broad way, is a play on electrification, as you said.
Yeah, so again, I mean, Polycab, so we have seen some concern recently related to the tax angle and so on and so forth. So I feel on a relative basis, I feel the value lies more in RR Cable as compared to Polycab at the current juncture.
Okay, so you like RR Cable. Let me expand that question. When you have lots of picks in small and mid caps, right? We discussed the wire and cable companies as Senco Gold, I can see Zen Technologies, JSW Infra and NCC on the infrastructure side. So if I were to ask you to pick top three, what would be your top three mid cap, small cap recommendations for FY25?
So I would like to go ahead with APL Apollo Tubes. Again, the story lies with a migration from commodity business to the value-added product. So we will see a kind of margin expansion coming over there as the product mix shift towards the value-added product. At the same time, we have seen their Raipur facility up and running, which has expanded the capacity for the company by close to 2 million tons. And what we feel is that earnings are likely to grow at north of 30-40% CAGR in FY25 and during the FY24 to 26 period. So APL Apollo Tube is one of our top pick with a price target of 1900 over the period of next 12 months. Zen Technologies, again, a small size company as far as the defense sector is concerned. Right now, likely to deliver 500 crore top line in FY24. And we believe that, again, this is one of the company which is likely to grow at 30-40% CAGR over the period of next 3 to 4 years with a robust order book under its hood. I think this is one of our top picks. And one company which we like is from EMS Electronic Manufacturing Services, Firma SGS. So recently we have seen that their margins have come under pressure due to the adverse product mix. So we have seen the consumption contribution from the consumption sector increasing slightly, and that had led to the pressure on the margin. But what we feel is that, again, this is one of the company which is growing at 30% plus CAGR as far as sales and earnings are concerned. And we feel the margins which are currently in the band of 5 to 6% will again go back to 7 to 8% in FY25 and FY26. So that will be our pick as far as FY25 is concerned.
Thank you very much, Sunny. This was a rich conversation. So many stocks you spoke about, whether it's M&M, APL Apollo Tubes, Zentech, Firma SGS, Zomato. Thank you very much for your insights and the way you're approaching these individual stocks. But back to the policy. RBI Governor Shaktikanta Das, in his policy, addressed the calls on banks, NBFCs and other regulated entities to give highest priority to governance and adherence to regulatory guidelines. Listen in.
Banks, NBFCs and other financial entities must continue to give highest priority to quality of governance and adherence to regulatory guidelines. The Reserve Bank has also been engaging with the regulated entities and various stakeholders for simplifying its regulations and reducing compliance burden. As part of this endeavor, the recommendations of the Regulations Review Authority RRA 2.0 constituted by the Reserve Bank have been largely implemented.
Well, as we slip into a break, we have an announcement to share with all of you. We are launching CNBC TV 18's first ever live personal finance webinar, CNBC TV 18 Accelerate, Personal Finance Handbook with Sonia, where she'll be joined by 3 well-known experts on Saturday, the 11th of May, 9 a.m. onwards. We'll be diving into everything you need to know about your finances. You can learn to grow your wealth, be it insurance, tax savings, managing your portfolio, retirement planning. There's lots to learn and lots to do. Whether you are in your 20s, 30s or 40s, this live webinar is for you. So we have limited seats, so don't miss this chance and register now by scanning the QR code, or you can log on to cnbctv18.com, and we'll see you on the 11th of May.
Welcome back. It's been a sort of a quiet, range-bound day for our markets. We've had the policy, but the policy hasn't dented the markets. It's come bang in line with expectations. No change in rates. Rates remain unchanged. Stance remains unchanged. FY25 GDP growth forecast is unchanged at 7%. And even the FY25 inflation forecast of 4.5%, has been maintained. So this has really been a very quiet, no action kind of a policy. And the market, at least at the index level, is reflecting that. But back to earnings, that's going to be the big Q. And the first of many real estate Q4 updates have been pouring in. Sonal joins us for more. Sonal.
Thank you for that. Well, let me start with Macrotech Developers. It was a decent set this time around. The company has been able to meet its FY24 pre-sales guidance of 14,500 crore rupees. But when it comes to new project addition, the guidance has been exceeded. Project additions have come at 20,300 crore rupees versus a guidance of 17,500 crore rupees. Overall, their Q4 pre-sales is up 40%, collections is up 20%, and net debt has declined to 3,010 crore rupees, which is below 0.2 times to equity, something that the company had been guiding for as well. Quarter on quarter, the sales are up 24% and collections are up 35.5%. On an FY24 basis, the pre-sales is up 20% and collections is up 6% for the company. Puravankara was another good set. Their pre-sales volumes are up 93%, their sales value is up 93%, and the realizations are flat at 8,320 rupees per square feet. Even on a quarter-on-quarter basis, we've seen a big uptick coming in their sales and volumes. FY24 numbers looks robust as well, with volumes up 84%, value up 90%, and company says it is the highest ever collections that they've seen and the highest ever sales value as well for FY24. On the flip side, while Sobha did see an increase in its sales value, sequentially there was a decline in volumes, and that is something that the street seems to not like, because sales value, while it was up 3%, sales volumes were down 9%, their realizations were down 2.5%, both on a quarter-on-quarter and on a YOY basis. Overall, FY24 sales were good, sales up 27% and volumes up 8.5%, but if we compare it with the peers, they have seen a degrowth, and that is the reason the stock is lower.
Okay, got that. Thanks very much for wrapping all of that up for us, Sonal. And with that, we do have to take a quick break. We'll come back on the other side, and then we will discuss everything that's buzzing in the commodities segment today. Crude, by the way, is making big headlines, above $90 a barrel. We'll have more with Manisha Gupta in just a bit. Welcome back. Let's now focus on commodities. Manisha Gupta is joining in. And of course, she's talking about these crude prices, which have hit multi-month highs. We're talking 5-month highs above $90 a barrel. So, Manisha, fill us in. What are the latest factors at play?
Oh yes, the crude oil prices continue to be on a boil. We are trading at a 5-month highs, and this is going to be a second straight week of gains coming in. For the prices, we've done $91 a barrel for the Brent prices here, while WTI is trading above 85. Well, broader conflict concerns in Middle East is a concern that is keeping the prices on the higher side. There is concern about disruption of supplies there. More Russian oil and fuel is now getting disconnected in sense of production and exports as well. And then OPEC and allies in the meeting in this week have said that they will continue with their production cuts by end of June. That is the current quarter. That is improving Chinese economic data is also aiding demand impact there, and that has been positive. And then there has been a report from ANZ which says that in next 3 months they've improvised their target higher to $95 a barrel. There also is a report from JP Morgan that says that for the month of March the demand was quite strong at 101.3 million barrels per day. So we are looking at strong demand numbers. The dollar index has seen a bit of a weakness. There are supply disruptions. All of those factors continuing to support crude prices, with most Wall Street banks and brokerages anticipating that crude will range between 90 to 95 for this current quarter.
$90 to $95 per barrel on crude. Manisha, thank you very much for that. By the way, things have been quiet in the last 1 hour. I think only the Nifty Bank has picked up a bit. When we started trade, it was up 150 points on the index, Nifty Bank. Now it's up more than about 200 points. But with that, we're going to take your leave on Trading Hour from the entire team. Thank you for watching.